Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman, along with Diane King-Hall in for Brad Smith today. Here are three things you need to know this morning. Call it the calm before the storm. U.S. stocks are just short of 15-month highs as results season kicks up a gear this week. Bank of America and Morgan Stanley report on Tuesday. Goldman Sachs rounds out results for the big banks on Wednesday. And we also get the double whammy of Tesla and Netflix after the bell that same day. According to FactSet, blended earnings on S&P 500 companies are expected to drop by 7.1% year over year in the second quarter. Deflation fears grow for the world's second biggest economy after disappointing growth data. China's second quarter GDP grew at a slower than expected pace of 6.3% on an annual basis. Data also showed the first economy-wide price decline since 2020. Wall Street is reacting, with Citi and Morgan Stanley both cutting their GDP forecasts to 5%. And last week's landmark ruling in the crypto space could shake things up dramatically. A New York judge ruled that Ripple's XRP cryptocurrency was not necessarily a security. That's a major setback for the SEC in its bid to regulate the space. The agency sued the blockchain startup back in 2020, alleging it conducted a $1.3 billion unregistered securities offering. The decision could also galvanize other firms facing SEC charges. So is this a watershed moment? We're going to ask Chair Gary Gensler in our big interview this afternoon at 3 p.m. Eastern.
Well, bank earnings came out of the gate hot on Friday. JPMorgan Chase led the pack, boasting a 67% jump in profit from the year prior, boosted by the acquisition of First Republic. JPMorgan, along with Citigroup and Wells Fargo, collectively grew their loan books to pad revenue for the quarter. All three lifted forecasts for lending profits in the year ahead, signaling no anticipated shift in borrowing. Joining us with his outlook on the sector is Gerard Cassidy, RBC Capital Markets Managing Director. All right, Gerard, thanks for joining us. First off, let's get into the results. We had a set of numbers the end of last week. What's your overall takeaway from that, and what are you looking forward to from, say, the banks ahead, Bank of America, Morgan Stanley, Goldman, in the week ahead?
Sure. Thank you for having me on the program. And when you look at the results that came out on Friday, a couple of things jumped out to investors. First and foremost, even though the net interest margin came down slightly for a few of the banks, such as JP Morgan and Wells, it actually went up for Citigroup. The net interest income growth, which is the backbone of revenue for all these banks, was actually quite positive, especially on a year-over-year basis. So I know there's been quite a bit of fear about deposit rates moving higher. And as you saw this quarter with these bigger banks, that was under control. They did go higher, don't get us wrong, but it was under control. The other thing that struck us was that the companies saw loan growth. And so even though loan growth is slowing, they're still reporting loan growth, which of course affects the profitability, especially in the consumer businesses. You know, JP Morgan Chase and Bank of America, who's going to report tomorrow, are the leading consumer banks in the United States. And JP Morgan Chase on Friday's return on equity in the consumer banking business was close to 35%. So it's been a very profitable period for the consumer banking business. And then lastly, credit. The credit picture remains strong. Wells did build up their loan loss reserves because of their exposure to commercial real estate, particularly in California. But overall, credit trends remain strong. They're normalizing, meaning credit losses are slowly moving higher, but it's coming off of a very low base.
Gerard, particularly for JP Morgan, as you mentioned, that return on equity, not just in the consumer business, but overall, was sort of eye-popping in comparison with some of the other banks. Has JP Morgan set the bar too high for the rest of the banks now that are going to be reporting this week?
Well, when we look at the return on equity for the consolidated company, you're right, it was quite high, and we need to pull out of there. There was the bargain purchase gain, as you might recall, when they bought First Republic. And what that tells you is they bought the bank at a discount to book value, which is why they had that gain. And when you pull that gain out, the return on equity still drops. But that being said, you're right, they still are a leader in the profitability for the banks. They set themselves apart from the group, which is why their valuation is the highest amongst the big banks, because they're most profitable. So we expect to see the profitability of Bank of America remain robust. Clearly, some of the bigger broker dealers or investment banks, Morgan Stanley, Goldman Sachs, will be affected by market conditions more so than JP Morgan was. But you're right, JP Morgan has definitely differentiated itself. It's the most profitable of the biggest banks, but in doing so, it's also the most valuable or the most highly valued based on price to book or price to earnings multiples.
Let's talk about another big bank. So Goldman Sachs, in the past, typically it doesn't guide on earnings, but there's been some whispers about its numbers coming ahead of its results this week. Is there any cause for concern, or are you worried about anything in terms of Goldman's numbers this week?
What we're likely to see, and I like how you say whispers, it's kind of like from a loudspeaker, I think, in terms of the media coverage. But anyway, they're not going to be very good. The company is obviously being affected by market conditions, similar to the other, investment banks or universal banks such as Bank of America, Citi, and JP Morgan in terms of their trading results and investment banking results. We all know investment banking, as evidenced by Friday's numbers, is very weak, and that's Goldman's forte, as we know as well. But Goldman's got other challenges they're going to report in the quarter. They're going to write down a number of their investments. There's a belief that they may even write down some of the acquisitions that they've done recently, and Green Sky in particular, as they attempt to sell that company. So that's what's going to compound and make their numbers look far worse than their peers, is the number of write-downs that the company's likely to take this quarter, including some real estate write-downs. As we all know, in the office real estate markets around the country, prices have come down in some cases in markets like San Francisco or Los Angeles, New York. Prices have come down from Class B and C buildings quite materially. And so we expect to see tough core fundamental numbers for Goldman. But on top of that, we expect to see write-downs of different assets that they have on their books, and that will compound the problem for them.
Gerard, are David Solomon's days numbered as CEO of Goldman Sachs?
It's going to be interesting. He's certainly had a tough time of it lately. And I think if he can put together a plan that is very credible for after this quarter on how he's going to return the bank back to profitability, kind of bring it back to its roots, as well as having a strong wealth management business, and set the company on that path, that may enable him to be able to still be at the leadership role at Goldman Sachs. Now, if he's unable to really put together a strong plan for the second half of the year, his tenure there could be in trouble. So we'll have to see. It's really going to be based upon what he's able to deliver after this quarter and the outlook that he can give investors and his senior partners at his organization.
Gerard, I want to switch gears and ask about the regionals. And you cover sort of the so-called super regionals, right? The bigger regional banks. When you were talking about how the biggest of the big banks are doing, how much of that is going to extend to the regionals, which obviously had been a more sort of challenged area coming out of the mini banking crisis, as it were, in the spring?
It's going to be interesting because you're right. The regional banks generally are not as diversified as our money center banks or universal banks. And certainly some of the smaller regional banks felt more deposit pressures than the bigger super regionals. And I think most regional banks really do not want to show any type of meaningful decline in deposits because of what happened with the banks that failed earlier this year. So they've been paying up for deposits by using certificates of deposit, or term funding as it's called. And so that's going to put pressure on their margins, probably more so than what we saw on Friday from the biggest banks. But once we get through this quarter and the fear of having any deposit declines fades, because we're further away from the March period where Silicon Valley and Signature banks failed, and of course in May when First Republic failed, I think there will be less pressure on the banks to have to pay up for deposits. Also, if the Fed reaches the terminal rate for Fed funds, historically what we have seen is that 3 to 6 months after that terminal rate is reached, deposit rates stop going up. So this will be a very tough quarter for margins and net interest income for the regionals, but we think that it becomes less difficult in the second half of the year. But you're right, the upward pressure on deposits for the regional banks will be evident by the decline in net interest margins that the market is expecting for these companies this week.
Gerard, I want to go back to one thing you said about the issues with regard to commercial real estate. Now, last week, McKinsey put out a report saying that the remote work shift is going to erase some $800 billion in value from office space by 2030. So which banks do you think are going to be hit hardest? Is it going to continue to be the regionals, the super regionals, or how much impact will it be to the big banks?
It's a good question because the work from home has certainly changed the dynamic of office space in this country. It would be interesting, though, to see how it plays out over a multi-year period. You know, there are many companies we talk to that are bringing employees back 4 days a week. Certainly in the tech sector, it's not that way. But it's a fair statement that there's obviously going to be a decline in the amount of space needed for large companies. But what's interesting, and you probably have noticed this with some of the high-profile commercial real estate defaults, most of, if not all of these high-profile defaults, like Brookfield's handing back the keys, so to speak, on that big Los Angeles property earlier this year, the lenders on these properties are not the banks. It's the commercial mortgage-backed securities industry. So it's the shadow banking industry has the biggest exposure to these higher risk properties. Now, don't get me wrong, the banks have exposure, but many of those banks have exposure to properties that are not going to be as affected by the work from home shift because they just don't have as much office exposure, and they certainly don't have as much office exposure in our biggest cities where the pressure is most acute because of the commutes going into the cities being, let's say, an hour to an hour and a half. Also, unfortunately, the higher crime rates, et cetera. And so most of the banks are not in these big cities like San Francisco, New York, Los Angeles, Chicago. And so therefore, yes, they will have some challenges. We don't deny that. But it's not cataclysmic as some of the headlines make it out to be. And again, thus far, the really big problems have been absorbed or been hit to the shadow banking industry through the CMBS market and not the bank's balance sheets.
Gerard, thanks for this. We are going to obviously watch all these numbers very closely to see what they have to say about commercial real estate and everything else. Gerard Cassidy is RBC Capital Markets Managing Director. Thanks, Gerard.
Thank you.
Well, if projections are correct, the S&P 500 could see the largest earnings decline this season since 2020. Yet the few companies that have reported have surprised to the upside with better than expected earnings per share and revenues. With a packed week of earnings ahead, what can we expect? Now let's bring in Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. And Lori, companies always beat estimates by and large, but but then you have the tone, you have what they say about what's coming next, et cetera. So we've been asking a lot of people the question about whether the bar is high or low coming into this earnings season.
So I feel like from a sentiment perspective, the bar was low. If you look at forecasts for 2Q, 3Q, and 4Q, they've all been drifting down. So we don't have a lot of optimism about the out quarters. A lot of the sort of movement to raise this year's numbers has come from the beats that have come in so far. So I do feel like if things are better than feared, and I think that's really potentially something that could happen on the margin front. I think people are having a very, very tough time forecasting margins right now. Then I think you could see, some good feeling come out of this reporting season. That doesn't mean it's going to be sustainable through the end of the year. I do think, we're a bit above my target, so we are looking for some pullback at some point, but I don't think you're going to necessarily get it right now.
So not right now, then when are you expecting to see a pullback?
So one of the things we're watching really closely are sentiment indicators for both individuals and institutions. And so we watch the CFTC data on the institutional side, asset manager positioning and E-minis. That's kind of like seventh inning. There could always be a rain out, right? You could always go extra innings, but it's getting elevated, but it's not quite at that hold your nose and sell signal yet. To kind of put it more specifically, if you look at individual investors on the AAII CPI net bullishness data. They do that survey every week as well. That's been around 15% on the 4-week average. 30% on the 4-week average in favor of the bulls is where you get nervous. So that's another late innings indicator, but not necessarily, kind of bottom of the ninth.
Speaking of where we are, one of the charts in a recent note of yours caught my eye, which had to do with how the S&P 500 does during recessions and also in advance of recessions, right? And so what did stocks anticipate and when? And what does that imply about when that recession is coming?
So it's a really confusing issue. I talk to a lot of investors who are just scratching their heads over the rally we've seen this year, and I take them through our sentiment indicators, which have been constructive up until recently, our valuation work, which has been constructive. And they say, okay, fine, but if we're having a recession, how could the market possibly have priced it in before a recession even started? And historically, you do see the market bottoms about 4.5 months before the recession is over, after it's already underway. So you get that mid-recession pivot. But people are right on this point. And, what I've told people is you have to think about what kind of recession this is, if we even get it, by the way. I don't think it's a foregone conclusion. And so we've been pointing a lot of people back to 1945, which was when you had a pivot out of a wartime economy to a peacetime economy. 1945, I've done this study multiple times. I've been a strategist for 20 years. I can never figure out the decline in the market associated with that recession. And as we went back and dug into it, we realized there are a lot of similarities with today. Back then it was a technical recession. The underlying economy was okay. Consumption was strong. Private investment was strong. You had a big withdrawal of government support on the fiscal side. We got a decline in real GDP. We did have some inflation that was pretty strong to contend with back then, although it retreated a bit in 45. But the more and more you look at it, the more and more similarities you can find. And we've said, look, people keep pushing back on the idea of a recession because they say, well, the consumer data is still pretty strong. Companies' earnings are still beating. That's sort of similar to what we saw back then. I think the market can be mature enough, to kind of use that term, to say, okay, if this really is just sort of a technical recession that we have to endure to get back to normal, maybe we don't need to have a big disaster in the market.
You said if we even get one, and it's not a foregone conclusion, what is your analysis baking in? Is it baking in a recession now?
Our earnings data actually is, and our valuation model is. So we layer in consensus forecasts as tracked by one of the major news organizations out there. And it's got negative GDP on a quarter-over-quarter basis baked in for the latter part of this year and has for some time. Even then, we're still coming up with 219 on earnings. And what we found on the valuation side is that it's really the moderation in inflation that allows multiples to get re-rated and move up. GDP and PE multiples have a lousy correlation with one another. We do bake it into our model, but it's kind of a factor you can ignore, to be honest.
Bloomberg put it out this morning that if you look at strategists' forecasts for year end, they're pretty negative, right? And even though you sound pretty bullish, your forecast is not necessarily very bullish. Why not?
So I'm a numbers nerd, right? And so I basically have this rotating list of models, and we come up with, things, the cross-asset models, for example, are pretty conservative right now because they say, hey, the bond market looks more attractive than the equity market. You run, those kinds of models, it's going to give you, a pretty negative number versus where we are now and kind of a flattish to negative number for the year. Equity only, kind of indicators like that sentiment model I mentioned before was really, really bullish to start the year. So we're looking at all those things. And when we come up with a target, we're generally taking the median or the average or something in the middle, and we call that our base case. But we have been highlighting, look, our more constructive models right now can get you up to 4,800. And I think what's tricky with this time of the year, right, is these targets we're supposed to guess where the market ends on December 31st. It's not about where we go in September. It's not about where we go in November, although some strategists try to declare victory, if you hit their target at something other than December 31st. But weird things often happen in the fourth quarter. Weird things often happen in December. And I think the risk I see right now on the sentiment model, again, it's kind of seventh innings, not eight innings. We have another couple months like this. We have a nice summer. We're going to start looking really extended on one of the models that was really bullish to start the year. So that's where I'm struggling right now, to be honest. I see the case for moving up more. I can, I can see how my target's going to be too conservative, and we'll have to be humble about that if it happens. But we do see overbought conditions returning on some of the things that got us here.
All right, we'll put a pin in that conversation. Lori Cavacina stays with us. Now, last week's CPI-induced market rally gave investors hope that fears over prolonged Fed tightening were overdone. In the aftermath, we also got consumer sentiment data from the University of Michigan, which came in much better than expected. RBC says the release prompted them to revisit the relationship between consumer sentiment and stock market performance over time. So what exactly is that? Let's get back to Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Okay, so tell us about this correlation that you see.
Yeah, so, we do our weekly. It comes out on Mondays, and we're always trying to look for interesting things to talk about, whether it's questions from clients, things in the economic data, just, pertinent things. And I was really struck, by this big surprise on the consumer confidence or sentiment data on Friday. And I just, pulled out this chart that we have that just looks at year-over-year stock prices against consumer sentiment. And guess what? They've been moving pretty much in lockstep, especially if you look at the Russell 2000 over the last couple years. And I've been getting an earful about home builders recently. I think there's still just a lot of people that can't believe that part of the market's been as strong as it has. To me, it's just been sort of mimicking what we're seeing in the small cap space. But, I just sort of looked at this chart and kind of going back to the discussion we had earlier. I mean, we basically priced in a recession in terms of the percentage decline in the S&P last October. We actually did it on a small, large relative basis. We baked in a massive hit to the ISM in the small cap space last summer. So I can see in a few different ways pricing was consistent with a recession. Well, guess what? This consumer sentiment chart tells you it may not have been a recession last year, but consumers in this survey certainly felt as bad as they tend to feel in one. And guess what? The stock market is run by human beings. I mean, yes, we have machines, but there are, human beings that are pulling those machines as well. And, I think sometimes on Wall Street, we overanalyze things. We try to get too cute with our analysis. I think the simple answer to what's going on in the market is this year, this is a recovery trade. It smells like a recovery trade. The extent to which people hate it and have missed it makes it feel like a recovery trade to me. Every move off a recession low I have ever been a part of has felt like this. I've heard the same things over and over again. And that consumer confidence data just, sort of made it all hit home for me. Like, we're just recovering. We just priced it in early. It's not a big deal. Move on and enjoy the party.
Yeah, on a related note, it's really interesting. We talked to Kyla Scanlon last week, who coined the term vibe session, where you feel terrible, but the data looks good, which is kind of where we were last year. And she said things are maybe starting to improve out of it. Consumer confidence would be an indicator for that. So could we be in a weird position 6 months from now where people feel okay, but the unemployment rate has gone up, for example?
Right, and I think it's a question, right, of how bad those indicators get. I mean, we talked about 1945 earlier. The unemployment rate only went up to the low 4s. Well, that's what forecasters are anticipating this time around as well. So a bit of normalization in the labor market. Yes, some job losses, which are unfortunate, especially for those who they affect, but nothing, that's sort of terrible or as bad as what we've lived through in recent history. And I just think we forget sometimes that consumers have the ability, investors have the ability to sort of sense the big picture. And I think that's what's going on here. I also talk a lot about in a recession, there's kind of a snowball effect. And I'm not an economist. So I'm sure all the economists around the street are going to cringe. But there's this whole thing of, well, we're heading into a recession, so companies scale back, and then consumers get freaked and they scale back. And I do think that the labor shortage is causing companies to not overreact. They're still talking in their earnings calls about this being a short, shallow recession, so they don't want to over-prepare for that. They want to be ready for the upside, but that cascades down to consumers as well. So yes, they're going to be a little more careful, but they're not going to freak out. They're not going to panic, and I think that's what we're all seeing.
Really interesting. All right, Lori, stick around because we want to talk more international. China's weak second quarter continues to raise alarm bells for economists. The world's second largest economy saw GDP grow 6.3% from a year ago. That, though, was lower than analysts and economists had estimated, and it showed a slowdown from the first quarter. That disappointing print caused major banks to cut their year-end growth forecast for the country. JP Morgan, Citigroup, Morgan Stanley all downgrading their projections for economic growth this year to 5%, putting Beijing's official gross domestic product target of around 5% at risk potentially. Deflation is a major risk now for China, with data showing economy-wide prices declining for the first time since 2020. Lori Calvasina is still with us, RBC Capital Markets Head of U.S. Equity Strategy. I know you don't cover international stocks, you cover U.S. stocks, but obviously China has been quite important for the U.S. How should we think about the current growth profile in China and what the implications are?
So I do talk to a lot of global investors, even though I don't cover global markets specifically. And one of the things I was struck by at the start of the year was just how complacent the bullishness was on China. And even, sort of middle of the second quarter, I was still talking, I did a trip over to Europe, and I was still, talking to a lot of folks over there who were, telling me how great the Chinese consumer was and how great the recovery was. And I said, well, I just came out of a reporting season where there was a lot of mixed commentary from the U.S. companies, and they were managing it pretty well, but they weren't, just sort of ringing the bell and celebrating and say, hey, everything is great. I think there are spillover effects. I think they are manageable in the U.S. That's certainly what we've seen so far. I don't think the planning was for a lot of optimism around China in the U.S. the way it may have been with European companies. I think the spillover effects will be greater in Europe. Because they were all, all the investors I were talking to were sort of singing how they were going to benefit the most, so that reverses. But I think beyond just sort of the ability of it to impact our economy, it's impacting money flows. And if you look at data from EPFR, you can already start to see the inflows to China fading a little bit. And so we had seen all this money wash into China, all this money wash into Europe to start the year. Well, guess what? The European equity flows are now negative. China is topping out. We're seeing money going into Japan. We're starting to see it pick up for Canada. And guess what? It's picking up in the US as well. That was originally driven by growth funds. Now it's morphing over into value funds. It's broadening out a bit. So yes, there's the knock-on effect to our economy, but it's actually quite positive for the US from a money flow perspective if you stop some of that money going into things like China and bring it back to the US.
Okay. Does that then make us too, kind of too insular redirecting it? You wonder if it limits just the emerging market and international exposure in general.
I think in general, I started back in 2000 over at Citi, and I used to call it the gospel of global growth. It was just the world is going global. We used to have to do all these studies where we pick through financial statements and find the international exposure and the China exposure, and that stuff used to be really hard to find, by the way. And now that's all reversing, right? So to the extent that we are a little more insular, I don't know that investors care that much because right now the really, kind of sexy theme out there is reshoring and reindustrialization. And all these crises we've had, the trade war, the supply chain shock, COVID, the inflation shock, it's all convincing us we need to invest more at home, and that train has already left the station. So that's really the big theme that people are going to be playing the next few years.
That is really interesting. Lori, you're going to stick around for a little bit more. We got much more markets action coming up ahead. Stay tuned. You're watching Yahoo Finance.
What do you believe the tenor that banks need to strike, especially coming off of the crisis and the turmoil that ensued in March of this year?
I think the banks really need to give off a feeling that they have solid balance sheets, they are in good shape, they're willing to serve their consumers, they've got those net interest incomes that are going to be strong, and we've seen that so far already this morning. So I think they want to give off a positive note with a little bit of cautiousness. Obviously, Jamie Dimon and what he's going to say is going to be key for the rest of the group and what the stocks do going forward. But I think they want to give a sense that they're in good shape.
We just had the opening bell on Wall Street, so let's do a quick check of the market sponsored by Tasty Trade. We've got a mixed open on this Monday morning here. Really little change here. The biggest change is in the Nasdaq, which is down just about 0.2%. A lot of sort of waiting, perhaps, this morning on the part of investors until we start to really pick up with earnings starting tomorrow with a number of the banks continuing through the week, as well as we talked about, some of the other big heavy hitters like Tesla and Netflix reporting this week. So in advance of that, a little bit of a quiet trade.
All right, the Nasdaq 100's big makeover is underway, but how effective will it be? The tech-heavy index is getting a special rebalance because just 7 companies listed account for about 51% of the index as of June 3rd. Now, those tech giants known as the Magnificent Seven are Amazon, Apple, Alphabet, Meta, Platforms, Microsoft, NVIDIA, and Tesla. Joining us now to break this all down is Yahoo Finance reporter Jared Blickery. Jared?
Hello. Well, we've been talking about this for some time. This is today's performance in the Nasdaq 100. Let's go to a year to date, and we can see the concentration among these 7 issues. Indeed, the performance really just out of the sight here. NVIDIA up over 200%, Meta up over 150, Tesla 130, and sizable gains for everything else here. I'll say this, in June, we saw an expansion of the rally, but over the last 5 days with that huge drop in the US dollar, with the big drop in rates, this is over the last 5 days. We've seen these mega caps lead once again, and this is leading Wall Street desks to anticipate what's going to happen as of the close of this Friday, the beginning of Monday, with this rebalancing in the Nasdaq 100. David Kostin over at Goldman Sachs saying that the concentration in tech in the Nasdaq 100 is going to go from 51% down to 49%. So he's saying, well, big deal, kind of, right? That doesn't seem like it's going to remove the concentration effects from the Nasdaq 100 itself, and that would be to make it an actively managed, diversified portfolio. But I do have a Wells Fargo note as well, and if we take a look at, this is the Nasdaq 100, up 42% year to date. By the way, just had its best 6 months in history, at least for the first 6 months of the year. Wells Fargo went through the numbers, and this is what happened in 2011, the last time there was a special rebalance. Back then, the issues that had to be upsized, in other words, they were underrepresented, included Microsoft and Alphabet. Now, those are 2 names which are being downsized today. So I just wanted to bring that to readers' or viewers' attention here. And I'm going to go back and I'm going to show you Wells Fargo has computed what they believe is going to be some of the downsized and upsized issue. Now, we know the Nasdaq 100, these are the big 7, those are going to be downsized. Apple, by the way, will be the only one that remains above 10%. It's going to be about 11.5%. Microsoft sliding down to about 9.8%. And here is that basket of stocks that are going to be upsized. Intuit, that's and you can see over the last 5 days, investors have been adding to some of these stocks. Starbucks, Mondelez, Gilead, ADP, Analog Devices, et cetera. This is the Wells Fargo analysis. Separately, over at Goldman Sachs, are saying Broadcom going to be the biggest beneficiary of the upside. That chip company going to become 3% of the index instead of 2.4%. But again, if you're shrugging your shoulders and saying these changes don't seem like that much, you're probably right.
Not that much, but when you're talking about the amount, the sheer volume of cash that tracks the Nasdaq 100, you're definitely going to see some changes.
At the margins, it's going to matter.
Okay, thanks, Jared. Appreciate it. Well, the S&P 500 and tech-heavy Nasdaq do continue to be ruled by just a few mega-cap stocks, as we were talking about. How much longer can this dominance continue? We're bringing back in Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. This is a conversation we've been having for months, Lori.
Yes.
When is the dominance going to change? When is market leadership going to shift? We still haven't seen it. When are we going to see it?
I think that what you see, if you just look at the price action and we look at all these trades, it's attempting to happen. And it's just not quite breaking out. You know, I'm an old small cap strategist, so we look at small versus large very closely. You know, I have people sending me these, well, small caps have done, great on this time frame, on this week or whatever, and we've had some nice days there. And you can definitely see that part of the index starting to move. If you look within the Russell 1000, we're seeing lower quality factors start to outperform. That is something that typically happens when you're coming off of a recession low. So that makes me believe that one of the things that you you need to find to really allow the kind of dominance of this mega cap growth story to unfurl a bit is just for greater faith in the recovery in 2024 to percolate. So just renewed conviction in that, pulling up some of those GDP forecasts for next year. I think kind of generally more excitement in the cyclicals, because one of the things we do see historically is that people will pile into big cap growth stocks and secular growers, and a lot of these are, sort of accused of being only benefiting from AI. I don't believe that, but that's what a lot of people are saying. But people want those secular stories when economic growth is lacking. So we're going to have to see some more excitement about the economy, I think, come back.
So what is going to fuel that excitement? Is it that we have to get past this next meeting from the Fed coming up later this month, or is it that we need to see more of these earnings that will beat expectations because the bar has been lowered?
I think most of the equity folks I talk to are, have been of the opinion for a while that the Fed was going to be higher for longer, right? So I don't think losing cuts this year, is something they were ever really looking for to begin with. I think people just want some more reconfirmation that the Fed is closer to the end. They'll tolerate another hike or two just because they want inflation under control. But it's really going to be an appreciation for the Fed, looking at the economy. I think you have to see conversations about the dual mandate come back in. You really need inflation under control a little bit more for that to happen. But I think it's going to be the details on the Fed as opposed to just whether or not they're going to hike again.
Of course, the irony about what you were just talking about with an improving economic environment being better for some of the more cyclical names is that could also still be good for big tech, right? Because those, as growth companies, they would also perhaps be seen benefiting. So it doesn't sound like it's necessarily that tech would not do well. It's just that everything else on a relative basis would do better.
Right. And, I've been overweight small cap. I have left my overweight on tech on. That was one we've had all year. Now, I'm being a little pickier in sort of the broader tech landscape, right? So a lot of internet companies are income, services, and consumer discretionary. We're neutral and underweight those sectors. So we want to be more discerning in our sort of technology bets, so to speak. So I think you want to be a little bit pickier, but I think there's nothing wrong with those companies, right? It's just they've kind of been the only game in town and the best alternative. I think that you've really, as you go through this reporting season, right, you probably need to see the banks come in less bad than feared. I think the regionals are going to be an important bellwether. One of these trades I mentioned that we've been watching have been the regional banks against the Nasdaq 100, or just the bigger cap banks against the Nasdaq 100. And those are sort of at past inflections, and you can see the banks trying to stabilize as they've sort of come back to these places where they inflected in the past. So I think it kind of all adds up. I think it's the consumer, the economy, and I think it's the banks themselves. We talked to Gerard earlier, but John Arfstrom, our regional bank analyst, has talked about just already needing a reset, right, on this quarter. And that is often, what gets rallies started, right, when things are less bad than feared and you kind of get all the bad news in the numbers.
Okay, a reset. Not a Control-Alt-Delete, but a reset.
Right, right.
All right. Lori Calvasina, thank you so much for joining us this morning, RBC Capital Markets Head of U.S. Equity Strategy. Shares of electric vehicle makers rallying today after BYD said it expects to triple its net profit in the first half of the year due to strong EV sales, showing little impact from the pricing war in China. Rival Tesla also had good news. The EV giant finally produced its first Cybertruck. The auto rolled off the assembly line at the company's Austin Gigafactory on Saturday. You can see other EV companies boosted as well. Rivian under some pressure though, but Lucid and NIO all up on the news from BYD and Tesla. Joining us now is Yahoo Finance reporter Alexandra Canal. Ali Canal.
Hi.
Hello.
Well, I first want to say the Cybertruck, I think, is one of the ugliest cars
on
the market.
It's terrible.
However, I do think that people that love Tesla, love Elon Musk, they're going to humor it because they're likely going to stay within that ecosystem. I also think we're going to see more EV adoption across the board, right? Especially with a lot of these charging stations popping up more and more. But what's interesting is there was a report that the Cybertruck will only have about 350-mile range. That would be significantly below the 620-mile range a Tesla said the Cybertruck would have in 2019. It also would be below the Chevy Silverado, which drives at a 450-mile range. It would be above the F-150 Lightning by 30 miles. But still, you wonder, once that news comes out, this is just based on a report, if that could affect Tesla stock price.
I mean, go ahead.
I was just going to say, the thing I'm curious about going forward, the Cybertruck is a sideshow for now, right? It's an interesting sideshow. It's an ugly car, blah, blah, blah. People want it, I guess. the price war is really the thing right now. And on that front, Ford just cut the price of its Lightning, its F-150 Lightning. So now it looks like that the pro-commercial truck, according to our Pras Subramanian, who has a story on the Yahoo Finance platform on this, is going to be cut by almost 10 grand. So the new starting price will be $49,995 for that pro line. So this just showing the continued competition, really, that is heating up so much in this industry. That's happening here. It's happening in China. To the case of BYD, it's happening everywhere.
And we know that that is part of what fueled Tesla sales recently, is just the pricing strategy they took after that last round of earnings. So I think we can expect to see more of that. But also keep in mind for the Cybertruck, it's been delay after delay, and it's just one. Right? They need to produce more. They had people who signed up for, who placed orders, and they had to stop because they were so far behind in terms of actual production of this. I mean, certainly good news for the share price today, and you're seeing the opposite effect to Rivian because of the Cybertruck.
Yeah, and you wonder how the pricing wars too will impact margins. We're going to hear from Tesla later this week, so I think that's going to be a key earnings report that a lot of investors will be tuned in on.
Yeah.
Can you imagine the blind spots in that thing? I'm just looking at it on the road. Like, you're not, I don't know. Anyway, all right, stay tuned. By the way, we're going to be talking much more about this EV landscape overall with Colin Rush, Oppenheimer Managing Director and Senior Research Analyst. That's coming up at about 10:45 a.m. Eastern.
All right, let's switch gears. We're watching shares of Paramount Global, the stock falling down 3% after the latest installment in the Tom Cruise-led Mission Impossible series disappoints at the box office. The film made $80 million domestically in its 5-day opening, below the forecasted $90 million. Now, we do have our resident box office expert with us today, Ali Canal.
Did anybody see it, first of all?
Did you see it?
I wanted to see it this weekend, and I didn't go because I was commuting back on Sunday, and that would have been the day I would want to go because of all the storms that we were having on the East Coast. But I'm a huge Mission Impossible fan. I've seen all the ones prior, so I will be seeing this movie in theaters. So that could go to that narrative of, okay, maybe it didn't surpass those expectations opening weekend, but down the line, longer term, perhaps we'll see more people go to the theater. But Paramount in general is an interesting company because it's had a lot of problems. A lot of problems. It's one of those companies that's long been rumored as a potential M&A target. They do have really successful franchises like Mission Impossible. You could even argue Tom Cruise is part of that narrative for Paramount. But there are clear headwinds at this company, especially when we talk about linear advertising headwinds. It's hitting all of these legacy companies across the board. Wells Fargo lowering its earning estimates for Paramount this morning, citing some of those concerns. Wells Fargo saying that Paramount should consider shutting down its direct-to-consumer business, maybe selling off the studio side of the business. But management has said that they want to stay the course right now. And I think that's causing a lot of analysts to stay on the sidelines. And then coupled with this box office news, it's not great when you're missing forecasts.
No, they've been looking to sell parts of their business for a while. They've sold some real estate in the past to try to just, streamline. So it's no surprise that we're seeing just both the chatter about them being an M&A target, but certainly, that was formerly my parent company. So I know, it's been a target and it's been in conversation, but you just have this push-pull at the leadership level on what to do. How do you solve a problem like Maria?
Yeah, exactly.
But the Mission Impossible, I'm actually not completely surprised about the opening because you think about how they had to pull back on press. We saw all the press happening going up into Barbie, which I know is a separate franchise. And I think that does help get butts in seats. So you're losing some of that push that, none of the big names can do any press right now.
Yeah, but that was really at the last minute before the movie, it feels like, right? I mean, literally at the last minute, you had, for example, the people at the, was it the Oppenheimer premiere who left out the premiere?
Yeah.
But but it opened already. So I do wonder about the implications more broadly for theater goers when it comes to Barbie, when it comes to Oppenheimer. Now, the estimates there are for what? $420 million domestically for Barbie, $194 million for Oppenheimer. I think those are box office pro numbers that were cited by Bloomberg. So there is a little bit of an extrapolation here. What happens more generally? What happens with the theater chains who are relying on people to come to this? So that whole ecosystem, Mission Impossible with such a big franchise like this, it raises questions.
Right, and Mission Impossible, you have that built-in audience, those fans that already want to go see this movie. You do wonder how it can influence a movie like Barbie, which has had so much hype, and we've spoken to a lot of experts over the past few weeks, and they said potentially the hype and all the marketing blitz that we've seen, it could be a double-edged sword for ticket sales. How does that translate?
Expectations too high?
Exactly.
Yes. And quick question, we're not back at pre-pandemic levels in terms of butts and seats. That's what I thought. Okay.
Yeah, not yet. And we likely won't be through this year. We do have a lot of strong films this summer. And maybe we just need to recalibrate our expectations, right? Like maybe we will never get back to pre-pandemic levels.
Maybe not. We are also watching shares of Chewie, the online pet supplies retailer. We're watching how that's trading. It's actually down 1.6%, even after it got an upgrade from Goldman Sachs, and the firm labeled the company a buy, saying its margins could steadily expand over the next 5 years as the company grows its private label and healthcare businesses. So this is interesting. The shares were higher in pre-market trading. They have now turned lower here. The analyst, Eric Sheridan, who led this, saying that the upgrade reflects, quote, our preference for platforms with greater exposure to less discretionary categories and that can lean on large ecosystems of buyers and subscribers for added visibility on forward revenue trends. So all that sounds great. And that's the argument, you guys, when we've spoken to Chewie, that they have made, that it is. There are discretionary categories, though, on Chewie.
Absolutely.
But this argument is that, like the dog food.
You need it.
You know, you need those things. So it's interesting to see the shares not rise with that upgrade.
And Goldman Sachs also cited from a valuation perspective too, Chewy shares have underperformed the S&P, which we've heard from other analysts too. A lot of these stocks have been overheated in a sense, so that potentially could be squeezed in the quarters to come. Chewy, however, has a more attractive risk-reward scenario heading into the back half of this year. But personally for me, I don't own a pet. I have no plans to own a pet. So
I love the way you said own a pet, because pet owners, they kind of consider them family. I don't know if they are you a pet owner? Okay. Do you say own a pet, or is like pet parent?
I don't know. I think
a child of sorts.
Okay, sorry.
I have human children. I don't know.
Yeah, well, my brother does have a dog. And, you know, you wonder with the healthcare side of things, do you pay for health insurance for your pet? No. Yeah, exactly. A lot of them do not. So I wonder what the runway is
for Chewy.
For Chewy, for that business in particular.
Yeah, I mean, look, they are considered one of best in class in terms of their space. And the stock is still up year to date. So they do still have some strength, just up 5%. So maybe this is a bet from Goldman on just the future performance. Like, so they've had them at neutral, and they're like, okay, there's room to run here.
Yeah, we'll see.
Indeed. All right. Ali Canal, thank you so much for joining us. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
How would you describe the state of the consumer right now?
I don't think you ever want to underestimate the consumer. We've said it all along. They always find a way to spend more money. I heard someone say the consumer spends money when it's happy, and it spends even more money when it's sad. So I think if we are going into a pullback later this year, the consumer is going to use some of that pent-up savings they have, even though they've been spending it already, to continue, especially as we head into a holiday season.
Now to the ongoing war in Ukraine. A critical deal allowing the nation to export grain via the Black Sea expires today, and Russia says it will suspend its role in that agreement. The truce was brokered last summer by Turkey and the United Nations and aimed to take pressure off the global food system by allowing grain from Ukraine to be exported safely. The deal was successful in bringing down prices of key grains. So checking on them in anticipation of maybe this deal having some problems. We've seen wheat that had been ticking higher in anticipation of the decision. Right now, it's little changed. The move all coming as Ukrainian media outlets reported that its forces were behind an attack on a key bridge that connects the Crimean Peninsula to Russia. Joining us now is Carlos Mera, Rabobank's head of the agricultural commodities market. So, Carlos, set the scene for us. Can you put this in perspective, how important this deal is and what the effect on grain prices could be?
Well, Ukraine is one of the major bread baskets in the world. And the fact that the deal allows 33 million tons of grains and oilseeds to be exported in the last year, that's a huge achievement. And that's one of the reasons why, for example, wheat prices have collapsed by almost 50% since the last year. Now, the deal was being delayed. Part of one of the prerequisites of the deal was that Russian inspections will take place before vessels will come into this corridor to pick up grains from the Odessa ports in Ukraine. Those inspections were delayed, so it wasn't working perfectly, but it was still working for the most part and allowing some exports to take place. Now, unfortunately, we're not going to have this deal in the foreseeable future, which means that all those grain oilseeds will need to move via alternative routes, which is either via the land borders in the EU, into the EU, or via the Ukrainian ports on the Danube, which are just across EU waters, which is a safe navigation route. However, either of those routes will involve much higher transportation costs, which means less money left for Ukrainian farmers.
And what are the implications of this for global grain supplies? Does this start to limit?
Yeah, to some extent. Well, we think most of the exportable surplus in Ukraine is going to flow via these alternative routes, but at a higher cost first. And there will be unavoidably some increase in domestic stocks in Ukraine because not all grain will move. But more concerningly, in the future, Ukrainian production might drop because farmers will get less money. They will probably have to sell below cost of production, and that means that agricultural production in Ukraine will tend to decline as things stand today, which is not great. It depends a little bit commodity by commodity, but we expect much more support for vegetable oils, especially cooking oils, and we expect as well more support for wheat prices. Wheat prices have already started to increase in the last few days, about 10-12% since Wednesday, also a little bit corn prices as well. And that puts a lot of pressure, especially on underdeveloped countries that will have to import especially wheat, which is essential for human consumption, at higher prices and more dependent on Russian wheat exports. Russia is the largest exporter of wheat in the world, so they will have fewer options.
Carlos, a lot was made, obviously, when the war began about the effects on global agricultural markets. How much, but it also feels like that the world is sort of adjusted here. So, even if you get these sort of shocks to the system at this point, do you think it is more resilient than it was 2 years ago?
Generally, yes. I don't expect prices to go back to the highs we've seen when the war started and in the couple of months following the war, when we saw, for example, wheat prices at almost twice the amount where they are now. But certainly we expect a little bit more support in wheat, and we had to look at the situation and the macroeconomic situation of some poor countries, which has arguably deteriorated in the last year.
Carlos, I've got to ask you, Secretary of State Antony Blinken recently accused Russia of weaponizing this grain deal. Is there any potential for this deal being resurrected?
I think this potential, but the conditions that Russia keeps mentioning, they're unpalatable for Western countries, like reconnecting Russian banks to the SWIFT system, for example. I think the West has been trying to give some allowances, maybe one branch of one bank to be reconnected, etc. But the position seems to be too far apart. Now, I understand President Erdogan will be speaking today with Vladimir Putin. There might be some developments. There might be some development, but as of today, position seems to be too far apart.
Carlos, thanks for joining us this morning, helping us understand this whole situation. Carlos Maurer, Rabobank, head of the agricultural commodities markets. Thank you. Stay tuned for our 3 to 5 p.m. show today. Our own Jennifer Schonberger is going to sit down with SEC Chair Gary Gensler for an exclusive interview as the Securities and Exchange Commission goes head-to-head with the crypto industry. You don't want to miss that conversation.
And all your markets action is ahead. Stay tuned. You are watching Yahoo Finance.
The Fed still looming large out there, and Fed Chair Jay Powell has not taken consecutive cuts off the table. However, even as we go into their next meeting and move towards that, the odds are for a hike. And so where do you believe that the Fed ends out this year?
Yeah, it's tricky because that number seems to change every day. You look now, we've actually seen Fed fund futures expectations come down 50 basis points just in the last couple of days since the CPI report. So I think the Fed's going to be probably somewhere between 5.25 and 5.5 on Fed funds futures. That looks to be in alignment with both the hawks and the doves on the Fed. So I think that gives us a good idea of probably where we'll end up.
It is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King-Hall alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving. We're looking at the S&P 500 searching for some direction this morning as the market faces a packed week of corporate earnings. The move comes after last week's rally on softer than expected inflation data that calmed investors.
And shares of AT&T are slipping on a downgrade from Citi on the heels of a Wall Street Journal investigation into toxic lead cables. Citi citing the industry's use of lead sheath cabling as an overhang expected to weigh on the stock for the next few months and possibly longer. Telephone and data systems and Frontier Communications also getting cut.
Shares of Bridge Biopharma soaring after the company announced positive results in a late-stage trial of a heart treatment. The drug will be submitted to the FDA for approval before the year's end. Bridge Biopharma shares have skyrocketed year-to-date, gaining 139% so far in 2023.
And finally, Pepsi shares are also taking a bit of a hit, down 0.9% after a downgrade from Morgan Stanley. Analysts cut the stock's rating to equal weight, saying most good news from Pepsi's recent earnings has already been priced into the stock. Last week, remember, Pepsi boosted its full-year guidance on better-than-expected earnings. Well, from data to earnings, there's a lot on the docket this week. Yahoo Finance's Josh Schaefer joins us now to break it down. And I know how excited you get about the calendar, so this is a good week for you.
It is a good week for me. Now, I started with the boring calendar, though. This isn't the most exciting one. We'll get this out of the way, we'll say, right? This is the economic data to watch this week, and it is not that full of an economic week, but two big things I'm watching here. We have retail sales tomorrow expected to increase 0.5% from last month, and I think that's interesting just as far as we've been watching for resilience, right? Resilience in the economy. Are things continuing to improve? Are consumers continuing to spend? Another positive retail sales print would certainly feed that narrative we've been talking about in the economy. And then in a light week, another thing I like to always highlight is jobless claims. We've been talking a lot about the strong labor market. Jobless claims broadly for several months now, really dating back to the spring, have been in a range of about 235,000 to about 265,000. Economists are looking for that number to pick up significantly if we're going to see any, quote, signs of softening in that labor market. But Julie, what I'm excited about is the earnings calendar. Let's take a look at the earnings calendar for this week. It's our first big week of earnings. So we got on Tuesday, we got Bank of America and Charles Schwab, Morgan Stanley highlighting more financials there. We also have Goldman Sachs coming this week as well. We know in financials it's going to be interesting to see from Goldman and Morgan Stanley specifically how their investment banking is doing. That was something that was sort of highlighted last Friday when you take a look at Wells Fargo and JP Morgan doing well, Citi maybe not doing as well in that area. And I think that's something to sort of watch in financials. But the other interesting theme broadly, I think, when we take a look at this list, Wednesday, you have Tesla and Netflix. And really what I'm curious to see there is how these stocks trade and how volatile they are in the day after earnings. Netflix up over 50% this year. Tesla up about 130% on the year. Are people going to say, you know, maybe these earnings were decent, but I want to get rid of and do a little bit of take some gains at this point in the year? I think is going to be interesting to watch. Tesla, those margins is going to be the key thing to look at. And then I added a special one for us now that we're in earnings season, guys. So to close out, we've got how companies are doing. So far, this is the S&P 500 companies in the S&P 500. 80% of the companies that have reported have beat EPS estimates. Now, if you follow this closely, you know not a lot of companies have reported that far. So I don't know how much we want to look into that number. But this week, as we just highlighted, we have 60 companies from the S&P 500 expected to report this week, according to FactSet. So we will get a lot of data on how companies are doing, specifically in that financial sector, and then we'll be able to pull a little bit more from that. And maybe this number will move next week, and I think we'll be able to glean a little bit more from it.
I have a special request. Can we add percentage of companies beating sales estimates as well?
We can.
Did you see Josh's
Thank
face?
you very much.
His eyebrows raised like, hey, I can only say yes.
We have the data. We'll bring it next week.
Let's do it.
All right. Josh Schaefer, thank you. More homework for you. All right. Now, what crisis? Big banks reporting Friday. JP Morgan Chase, Citigroup, Wells Fargo, they all delivered solid earnings. A strong showing in profits made it easy to forget the year's earlier chaos. Our next guest says all signs from big banks point to a soft landing. But how will high interest rates weigh on banks, both big and small, in the months ahead? Joining us now is Ben Eisen, Wall Street Journal reporter. Ben, thanks so much for joining us this morning. All right, Ben.
Thanks for having me.
Let's get right into it. Let's talk about these big banks. We had a guest on earlier who talked about the strength that we saw. You put out a report talking about just the picture that the banks are painting. What's the theme that you're seeing play out with regard to the reports that we've seen so far?
So it's important to note that we've only had 3 of the big banks out of 6 that have disclosed their earnings so far. But what we saw on Friday was honestly pretty good as far as what people were expecting. All of the 3 banks, Citigroup, Wells Fargo, and JP Morgan, they all beat estimates on profit and revenue. And when you kind of dug into the details a little bit, what you saw is that the money that they set aside for bad loans is really not that much. Their customers were borrowing, they were spending, and the economy kind of continued to hum along as shown, kind of coursing through these banks. And that's despite some of the worst fears that people had when you think about the economy. We've been talking for years about, are we going to have a soft landing, or are we going to have a hard landing? Are we going to have a deep recession? And it's obviously we don't know what's going to happen, but as far as what the banks are seeing right now, it really hasn't been the kind of hard landing that we've seen. It points more towards a soft one.
And given that we've only had a few of the banks come out so far, Ben, do you expect to continue to hear that, particularly from like the regional banks when they start reporting?
I think there will be a distinction between the big banks and the regional banks. What we saw among the big banks is that, some of what we saw during the crisis that we had earlier this year, with deposits leaving banks, these regional banks, and those banks having to replace those deposits with higher cost funding. We did see that at the biggest banks to a smaller extent. It impacted them less. They have sort of these more diversified big businesses where they can offset sort of higher deposit costs with other lines of business. Now, when you look at the regional banks, they sort of have less room to maneuver. These are banks that are more focused on taking deposits, making loans, investing in securities. So the higher interest rate, the hit from higher interest rates is going to be more acute at these smaller banks in all likelihood. So that may mean that a lot of these banks had to replace these deposits that left with higher cost funding. And when that happens, that kind of directly hits profit. It narrows the net interest margin that they earn. So I think that's something to be on the lookout for. How bad it will be, it's hard to say. And, all banks are sort of faring differently. But yeah, I don't think anyone expects the mid-sized banks to have as rosy earnings as the big banks have had. And, the big banks have actually sort of benefited in some ways from the trouble that we've had with regional banks, because when people took their deposits from SVB, for example, they brought them to JP Morgan and Wells and Bank of America. And so, you've had sort of the haves and the have-nots that we've seen over the course of the year.
Ben, speaking of the haves and the have-nots, there's been some divergence, obviously, in share price, and you dig into this. But when we look at kind of this as a basket, you look particularly at the KBW Nasdaq Bank Index, it being down for the year, but that's different from the XLF. What does that tell you, or what does that signal about kind of the state of the banking sector?
You definitely do see this kind of divergence that's playing out between the biggest banks and the regional banks. It's playing out in their share prices. JP Morgan, Wells Fargo, Citigroup, the ones that reported on Friday, those stocks are all up for the year. But when you look at the PacWest and Zions and Comerica and all of these banks that are in the regional space and have been just kind of battered all year long, they don't look so good. So there is sort of this pretty wide divergence that we're seeing.
Hey, Ben, stick around because we want to switch gears here. China's disappointing GDP numbers for the second quarter led several U.S. banks to cut their forecasts for the nation's full-year growth as China struggles to move ahead in its post-COVID economic recovery. Ben Eisen is still with us, Wall Street Journal reporter. So as we're looking at sort of the big economic picture and we're looking at China, how should we be sort of framing that issue?
It's interesting that we're now sort of talking about the global economy when transferring, right after talking about the big bank earnings, because the big bank earnings have sort of presented this picture of this, possible soft landing in the U.S., but that's really not what we're seeing in a lot of other countries. So, right, China had these very disappointing GDP numbers. The euro area slid into recession earlier this year. The rest of the world isn't looking as good as the U.S. is looking right now. So there is kind of this disconnect that we're seeing, as we look at kind of just all of the events that we've had, how they're weighing on various countries. So it's good to be the U.S. economy right now, and less so other parts of the world.
And Ben, there was a recent Goldman report basically downgrading some Chinese banks. What is the expectation that we're going to see a downgraded Agricultural Bank of China, Commercial Bank of China, and the list goes on? What is the expectation that we would see about exposure and kind of potential pullback of exposure in U.S. banks from China?
It's really hard to say right now. I'd point to what Jamie Dimon said when he was in China a few months ago, that he kind of took the language that U.S. officials have taken, that there's not sort of a decoupling between the U.S. and China. It's more of sort of a more realistic outlook on the bank, on the country itself. So a lot of these banks are very committed to being in China. Their relationship just might look a little bit different than it has in the past.
Ben, good to see you. Ben Eisen, Wall Street Journal reporter. Thanks.
Thanks a lot.
We got much more coming up. Stay tuned. You're watching Yahoo Finance.
I've been particularly interested in the growth of this one particular topic and story. Have you tried pickleball yet?
Listen, I was that person that was always picked last in school for the kickball team. I am not a very athletic individual, so I have not tried it yet, but I'm willing. So if someone is willing to put me on their team, I'll give it a shot.
Okay, done deal. I'm sure there are some sign-up sheets in your local neck of the woods, so we'll find those out and we'll circle back on that.
Let's do a check of the markets now, sponsored by Tasty Trade. We see all three major averages now in the green. The Nasdaq leading the way once again, up by about 0.5%. So just this continuing situation that we have seen with tech dominating the trade here, and with some large cap companies like Tesla and Netflix coming out this week, should be interesting. I note, by the way, NVIDIA's up again in today's session. That company doesn't report for several weeks, but looks like it's trading in another record today.
Wow, NVIDIA keeps on going. All right, the campaign trail is heating up with all major Republican candidates out on the road trying to gather support. A new report from Bloomberg suggests the winner of the primaries may not be as clear-cut as it was in the last presidential election season. Big Republican donors might be seeking an alternative to the former president, but they haven't found the singular candidate that they want. Let's bring in Yahoo Finance's Rick Newman to discuss more. Hi, Rick. So who is it?
We don't know. So this resembles 2016 on the Republican side, which is to say big donors are split. Some of them are going to Trump, but others are grabbing some of those big donors. So that would be Florida Governor Ron DeSantis, also the South Carolina Senator Tim Scott. He's getting some big donors. And then when you look at the small donors, Trump dominates. So those are people who give, it could be $20, it could be $40. They don't hit the limit so that Trump can go back to them. And I guess that's not surprising because Trump has had, basically 7 or 8 years at this point to develop that network of small donors. And anybody who has ever once signed up for a Trump campaign email, as I have, so that I can monitor what they're saying, you just get these Trump emails relentlessly. Every time there's some twist in one of the legal cases against Trump, he sends out an email. The Democrats are prosecuting me. Send $20. And it seems to work. So the GOP field is very fragmented at this point. Trump is leading in the polls. But because of his unique legal problems, there seems to be some likelihood that does not automatically make him the guy who will challenge President Biden next year.
Is there anything that would derail that scenario of him being the nominee?
Sure. He could get convicted of felonies. He could go to prison. And it's possible that he's just going to get so bogged down with these criminal cases. I mean, we've got federal cases against Trump. There's probably going to be there are probably charges coming in Georgia. There's the New York City case. He could end up so bogged down with all this prosecutions that he has to deal with that he just is not an effective campaigner. And he basically campaigns from a bunker in Mar-a-Lago. So there's nothing inevitable about Trump being the nominee, given how up in the air this whole thing is.
And there's nothing inevitable about him not being the nominee, if we recall how 2016 went as well, because he wasn't clear initially. All right, we will obviously continue to cover this. Rick Newman, thank you so much.
Bye, guys.
Bye. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Have you tried out Threads? Do you believe that Threads is going to be the Twitter killer?
I'm not sure if it's going to be the Twitter killer, but will definitely be some competition. I have an account on Instagram. I use Instagram. So yes, I did the Threads app, but in all honesty, I haven't gone through and looked at anything on there yet. Maybe it's a weekend activity. We'll see. But right now, I don't think it's stiff competition for Twitter.
All right, drop the @ for the team here, and we'll hit you with a few fresh follows on IG.
Perfect.
Microsoft and Activision have overcome yet another hurdle on the path to the largest ever gaming deal. An appeals court denied a Federal Trade Commission bid to pause the acquisition, leaving just the UK in the merger's path. Joining us now, Yahoo Finance reporter Alexis Keenan. So, Alexis, what happens now?
Yeah, so the market seemed to think that this is kind of a done deal, right? You look at the share price, it is just a couple bucks and a half below Microsoft's offer price of $95 a share, sitting there at 92 and change. But even if the UK, right, that has reopened its investigation, said it will begin talking again with Microsoft, even if the UK decides it ultimately wants to block this deal, these two court decisions are really important. So what happened on Friday is that an appellate court decided that it would agree with a lower court, with the district court, saying that the FTC is not has not shown that it will likely succeed on the underlying case. And so they would not allow the FTC to go ahead and try to block this deal from going forward. Very important, because if a court is saying that the FTC doesn't have a great case here, or is suspecting that it might not, well, that bodes well for them in the case were it to play out. Now, the FTC's case is still pending. It's a case pending in its in-house court. It's not in the federal courts. And also, the FTC could go ahead with that. So it's not necessarily a done deal, but at least Microsoft and Activision are not going to be blocked from going ahead. They do have that July 18th, that tomorrow deadline. But I think what we should expect here is that the parties will say, let's get an extension, let's not blow this up. There's a $3 billion breakup fee here that would go to Activision if it doesn't go through. But under these circumstances, with the courts siding with the parties, saying that they don't see too much of an anti-competitive concern, we should expect them to at least put it on hold. We've put that question out to Microsoft. We haven't heard back yet as to how they're going to respond or how they're going to deal with Activision. We also don't know if shareholders will be given some sort of a premium. Those are Activision shareholders. Will they be given something as a concession if this doesn't go through on the 18th. But we also, saw on Sunday, Microsoft making one more agreement to try to calm concerns, saying that it will offer its very lucrative franchise, Activision's Call of Duty, on Sony PlayStation. So now you have that added to the agreement with NVIDIA, added to the agreement with Nintendo, saying that they will try to calm these concerns. Now, for the FTC, these behavioral types of remedies, not great for the FTC. They don't want this, right? They don't want to monitor going out 10 years, whether the parties are keeping to their agreements. So that can cost the FTC a lot of money. They're not going to love that. But as for now, looking like the market at least thinks this thing will go through.
All right. Wow. You gave us a deep dive there in a very concise way.
Oh, I hope so.
Yes, we appreciate it. Alexis Keenan, thank you so much. All right, S&P 500 earnings are expected to drop by 7.1% in the second quarter, according to FactSet. That would be the sharpest earnings decline since Q2 2020. Can big tech companies be expected to lead in earnings growth this quarter the way they have dominated the stock market? We get our first glimpse of tech with two of the Magnificent Seven reporting on Wednesday, Netflix and Tesla. Joining us now with his earnings outlook is Dan Morgan, Synovus Trust Senior Portfolio Manager. So Dan, thank you so much for joining us. First, let's dive right into Netflix, which was also once before it was in the Magnificent Seven. It's a FANG stock. So what's the expectation for Netflix going into their numbers?
Well, everybody's going to be focusing on the new subscriber data. The consensus estimate for the second quarter is about 1.8 million new subscribers. And then going into the third quarter, we're looking for about 4.7 million new subscribers. So those are going to be the key statistics that everybody faces or focuses on. Also, people want to know more color about their Basic with Ads initiative. We think there's about 2.7 million subscribers that are on this new program that they have. So I think those will be the things everybody's focused on. As you guys know, Netflix always trades on new subscriber growth. So that's what everybody's going to be focusing on.
It does. The shares, Dan, are already up some 52% or something this year. Do you buy here going into the numbers?
Well, it's interesting because the stock trades about 38 times earnings. On a historical priced earnings basis, it's traded about 75 times earnings. So from that perspective, it looks very inexpensive. But you have to bear in mind that earnings growth has slowed down dramatically. Everybody remembers Netflix, just spending tons of money on content, didn't care about free cash flow, just drive that subscriber growth. Well, that whole thing has changed. So if you look at consensus estimates going into this year, growth is only 13%. So from a, price to earnings valuation versus growth, the stock trades, slightly above where it should, but it's definitely isn't the hyper growth company that was before, that was trading at 75 to 100 times earnings.
Is Netflix positioned well amid this writers and actors strike that is now upon us in terms of its content and just going forward?
Well, initially the thought process was that they had, conducted a lot of their programming kind of in advance of this, in anticipation of it. But as this situation continues to go on, it becomes more challenging, right? Because you start to get through all your shows and now you got to start new shows, especially Netflix, who's extremely reliant on, programs that go on for a very long period of time through these series. And that's how they hook people, opposed to a movie that could always be delayed. So I think initially, they were in pretty good shape, but as long as this continues to go on, it becomes much more challenging for various networks like Netflix that have to constantly come up with extensions on existing series and have writers write that for them.
And what are the Netflix margins looking like, not just here, but going into the future?
Well, their target margin is about 18 to 20%. That's what they're kind of targeting going forward. So obviously, as they start to become more focused on free cash flow, for example, in this upcoming year, they're expected to do about $3.9 billion in free cash flow. Their streaming obligation, contractual streaming obligations, about $22.9 billion. So they're definitely slowing down in terms of the amount of money that they're spending, and they're being more cognizant to margins, free cash flow, and not increasing debt so much. So as they continue to move forward, I think that you'll see Netflix become more of a margin expansion story opposed to a growth at all cost story.
Well, that's interesting. All right, Dan, stick around because we want to talk about the chips. NVIDIA, of course, setting the bar high in its last earnings report, raising the target for its second quarter. It expects revenue to come in at about $11 billion. Chip makers will be, of course, watched closely this earnings season, and NVIDIA still is the standout for most. Dan Morgan still with us, Innovis Trust Senior Portfolio Manager. So, Dan, we had some commentary today as well from Citi around the chip makers that we could see some boost this season, but with the bar set so high by NVIDIA, what does that do going into this season?
Well, what's interesting, if you look at the consensus estimate from the Semiconductor Association in terms of overall revenues for the semiconductor industry, they're expected to fall by 11%, and they were flat last year. If we look the price to book ratio of the SOX, right, the Philadelphia Semiconductor Exchange, which is a good gauge of the overall industry, right now it trades at about 5.1 times book, which is kind of in between a high of over 8, and then sometimes we've traded down in the 2s, for example, after the tech wreck and after the dot-com bubble blew up. So I think coming into this year, obviously the big excitement, as you guys know, has been all about AI. NVIDIA was the first company who really was able to show actual numbers where AI was impacting them. And now everybody else is kind of playing catch up. We have Intel reporting here the next couple of weeks, Qualcomm. Those two companies both have AI initiatives. I'm sure we're going to hear about that. We'll have AMD come in. They have their MIX 300, their new chip that they're developing in that space. So there's a lot of excitement about AI. I think what we have to see, guys, is some of that numbers trickling down into the actual revenue estimates like we did with NVIDIA. And at this point, it's been pretty sparse out of the chip space.
And can anyone else, can AMD or anyone else catch up to NVIDIA, or is it going to be a distant second, distant third?
Well, you're right. I mean, I just wrote a piece on that. I wrote a little note about 2.5, 3 pages on the whole AI chip space. And people don't realize NVIDIA has about 80% right now. Can you believe that? Of the AI market. And they were really the first to really blow that thing open. And it's like, well, who's going to be first? Who's going to be second or third? And we know NVIDIA is at the top of the pack. And then you look at maybe AMD as kind of a low cost producer like they've done in the CPU market against Intel. You've got the Jericho 3 chip, which is Broadcom's chip in that space. Intel's got Falcon Shores. You got Qualcomm with AI 100, which is their chip in that space. They're all fighting for that other 20% of the market. So it's going to be it'll be interesting. Marvel is also in there to see who can start to garner and grab some of that market share. But I think the overall chip demand for AI chips is going to continue to increase. So it's going to be shared. Even though, let's say, NVIDIA is still the dominant player, there's still enough room for these other companies like Marvel and Broadcom and Qualcomm and so forth. So it's definitely exciting when it comes to the chip space, because all of a sudden we have a whole new industry or a whole new space that we haven't had before.
Well, and at the same time, you still have the existing space too, right? Like chips are still going into everything now that have nothing to do with AI, right? So again, that Citi note that I alluded to is kind of liking what they call the microcontrollers, NXP, MCHP on semiconductor, for example, that they may be poised to benefit in this environment. So I guess what would you say to investors who are so focused on AI? Like, where are there other opportunities, places they should be looking within semis?
Well, I hate to say this because it kind of pops the balloon, but if you look at about a third of the semiconductor market, it's PCs, laptops, and smartphones. So that's a huge part of it. Automotive is about 10%. You've got industrial. You mentioned microcontrollers. That's a very specific part of the chip space. You also have the memory space, right, with DRAM and NAND and flash memory. And then that's going to be your Micron technology and Samsung and so forth. And really, a lot of those spaces, demand is very muted. I mean, auto is still pretty strong. Industrial is relatively strong. But you break out all these other segments. We had Micron reported numbers a couple of weeks ago. And, demand for memory chips is still very muted. And they are clearing out inventory and they're making, progress. But, I think it's still too early to say that we're having a broad-based resurgence in the demand for chips. But I will say that inventories are coming down. The consensus is that the second quarter of this year is the low point when we look at the downturn that we've seen over the last 6 quarters, and that we will start to see things improve coming into the third, fourth quarter. So I believe that's probably what the Citi note is focusing on, is this recovery that we're all expecting coming in at the low point of the valley here at the second quarter. So I'm optimistic and hopeful. AI is obviously a huge catalyst, and we just need a big turnaround in some of the core areas, smartphones, PCs and laptops, which we expect to occur the second half of this year.
All right, we'll put a pin in that part of our conversation. Dan, stay with us. Fund manager Cathie Wood was notable in her decision to bail on NVIDIA just before shares surged some 160%. According to fresh data from FactSet, it seems some investors are bailing on her flagship ARK ETF fund. Despite a steep rally this year, they've pulled a net $717 million over the past 12 months. Let's bring back in Dan Morgan, Synovus Trust Senior Portfolio Manager. Now, Cathie Wood's fund, I know, had gotten a lot of attention, was an investor darling. With regard to this NVIDIA play, do you think this was the wrong decision?
Well, I can't really comment on, Cathie Wood. I don't really follow her exact investments and what she's doing. I can say that NVIDIA did go through a few quarters where we saw a dramatic downturn in their core business, which was in their GPUs, which are their gaming chips, because of the downturn because of COVID. People weren't gaming as much, and you didn't have the same demand for that area. And then data center held up, which is an area that is their CPUs, for quite a long time. And then it started to deaccelerate. But I think that the wild card with NVIDIA was the fact that they had really been a pioneer some 5 to 10 years ago in terms of getting involved in AI, which obviously came to fruition on the last quarter. You mentioned the huge guidance they gave for their upcoming quarter in terms of revenue. So, I'm sure she was seeing some things. She made a decision on it. I will say at Synovus Trust, we've had NVIDIA on our buy list for quite a long period of time. We put it on because of the strength that they were getting in data center and AI, and not just being a gaming chip provider. And we never really changed our view on the stock as we continued to move through this real positive momentum. So I guess she made a call, and it was a tough call.
Hey, Dan, more broadly, does that tell us anything about investor sentiment towards tech stocks in particular? What are you hearing from clients right now?
Well, obviously the sentiment has changed drastically. I mean, I used to do interviews that talked about comparing the current movement in the tech sector today versus the dot-com bubble. So I haven't had to do a lot of interviews on that recently, but things have definitely improved. I mean, I think everyone's feeling like the low is coming and that we're going to start to get a ramp up. Now, as we go into the second quarter, you know, if you look at the consensus estimates you talked about at the beginning for the year on tech, it's expected to drop 8% in profit. So it's not expected to be a great year. In this second quarter, when we kind of go through the silos, you know, Google, Meta, you look at Apple, you look at Microsoft, you go down the list of all the big companies, you know, we're not expecting huge jumps in terms of profit or earnings growth. But I think everyone's kind of focusing on the future where they're like, okay, well, this sounds like it's going to be near the bottom or near the valley. So let's go ahead and buy the stock, anticipation of things improving as we go into next year. If you look at the consensus estimate on the S&P 500 Information Technology Index next year, overall growth or profits are expected to increase by over 16%. So we go from -8 to over 16%. So as you guys know, tech has been a sector that has been able to provide growth when other sectors have been muted in terms of profit growth. So I think that's why the expectations are going forward that tech will outperform eventually.
I'm sorry, you just said tech will outperform eventually. Wait.
In terms of profits.
Okay,
yeah.
okay. Because what I wanted to ask you, I just wanted to ask you one more question just about, is this tech play, like, is this basically done? Are we in, we had some comparisons to innings previously. Are we in the last innings or are we still in the early innings?
Well, you're asking the wrong guy. Because I've been investing in technology stocks for over 30 years, and I've gone through the ups and downs, and I just feel like there's tremendous potential in these segments. Tech is not going to go away. People are going to get rid of all their iPhones. We're not going to quit doing Google searches. So I just feel like, you know, yeah, we've had a big run. You've got stocks that are up 40, 50% like Apple and Microsoft year to date. And yeah, they've got to kind of level off a little bit, but I still feel long-term the fundamentals are still really strong. And I mentioned the expectations for profit growth next year at 16%. So I think, you know, yeah, it's made a big jump up and you might be in the 8th or 9th inning of this big move, but then still long-term, you would expect the sector to outperform.
All right. Longtime tech bull Dan Morgan, thanks for joining us. Synovus Trust Senior Portfolio Manager. Good to talk to you as always.
Yeah.
We got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What do you believe the tenor that banks need to strike, especially coming off of the crisis and the turmoil that ensued in March of this year?
I think the banks really need to give off a feeling that they have solid balance sheets. They are in good shape. They're willing to serve their consumers. They've got those net interest incomes that are going to be strong, and we've seen that so far already this morning. So I think they want to give off a positive note with a little bit of cautiousness. Obviously, Jamie Dimon and what he's going to say is going to be key for the rest of the group and what the stocks do going forward. But I think they want to give a sense that they're in good shape.
Tesla has officially completed its first Cybertruck. The EV maker unveiled the completed model on Twitter, showing a group of workers at its Gigafactory in Texas. Now, Tesla first revealed the prototype for the Cybertruck back in 2019, but pushed back the original release date for the vehicle due to supply chain shortages. For more on what this means for Tesla, we're joined by Colin Rush, Oppenheimer Managing Director and Senior Research Analyst. Colin, thanks so much for joining us this morning. So this obviously has been accretive at an earlier check to Tesla's share price. To you, is this a bullish signal for you that they finally completed this?
They're just delivering on one of the promises, albeit substantially late compared to what they had originally guided. But it just shows incremental progress from the platform. And we think the real driver for the stock here is a little bit of anticipation on Wednesday that they're going to post better than feared gross margins. And we think that's the real number that investors are looking at as they look at the results Wednesday after the close.
What is going to fuel, hey Colin, it's Julie here, what's going to fuel those better than expected gross margins, do you think, especially considering that they've been in this sort of price cutting mode?
Yeah, it's really around the supply chain and utilization on the factories. So what we're seeing is supply chain bottlenecks easing up, product becoming available, the utilization going up on the factory, and this is across the broader OEM complex. And so for Tesla, what that means is they've been passing on some of those cost savings, and I think some of the fear around the stock has been that margins would be lower for longer, and I think that still persists. But if they show a little bit of progress here off the 17.8%, margins ex credits from last quarter, I think there's going to be some relief from the bulls and some fear from the bears that things are actually getting better and that they can hit some of the higher end margins that folks are looking at in 25, 26.
So, Colin, Ford saying they're cutting the price of their F-150 Lightning by about $10,000. What do you think that means for Tesla and what it may have to do with regard to pricing?
I think all of these OEMs are working through what the right price is for the vehicles. And as fuel prices change, from geography to geography, we're seeing oil prices up and down a little bit. We're seeing electricity prices go higher. And with the credits that we have in the U.S., it's still about a $10,000 to $11,000 total cost of ownership advantage towards EVs. But when you look at kind of some of the base vehicles in the trucking market or the pickup market, the prices need to come down if you're moving away from a luxury sale into a real duty-driven sale for folks. And so I think the prices on a lot of those trucks are a little bit too high once you get out of the realm of fashion and luxury. And so Ford, although we don't cover them, I suspect is probably looking at that dynamic and saying, what do we need to do from a price perspective to drive volume? And we're seeing some of that today.
If I'm not mistaken, Colin, you are still at a market perform when it comes to Tesla. What would change your thesis at this point? Is there anything in their numbers, for example, that would change your mind?
This is an interesting question with this stock. So there's a couple of dynamics that we're looking at pretty closely. First is the gross margin issue that we talked about earlier, and their ability to ramp up to gross margins in the high 20% on the automotive side and the vehicles. The second thing is what the real commentary is around AI. Obviously, the stock ran as a lot of the market got enthusiastic around AI for broader applications, and under a number of applications within the Tesla platform, you've got some AI IP, the first one really being self-driving vehicles. You've got this robot that they're talking about building, and then the Dojo platform that's going to drive a number of learning cycles and faster learning cycles for the company. And so as we look at the stock, the first consideration is really what they're doing on the manufacturing side with the vehicles. And we think they're really having to compete on a performance basis and a cost basis with a much broader volume of vehicles as they get to higher volumes themselves as a manufacturer. And we're seeing that in the pricing dynamic. But the big question for the stock here, I think, is really what's the realization and the reality of AI within this platform. And I think there's a lot of hope built into the stock right now, but not a lot of meat on the bone. And so that's what we're looking for on Wednesday, is some commentary around that AI opportunity and how they're going to go about monetizing it.
Yeah, that should be very interesting. As always, though, when it comes to Tesla, and in particular when it comes to Elon Musk, there tends to be noise, right? The latest of that noise coming in the form of Senator Elizabeth Warren, who CNBC is now reporting has sent a letter to the Securities and Exchange Commission telling them to investigate Tesla and its board over what she is saying, and I'm quoting here, possible conflicts of interest, misappropriation of corporate assets, and other negative impacts to Tesla shareholders, all of this having to do with Musk's Twitter takeover. So his takeover of Twitter, his interest there, and then sort of the feedback to Tesla. What do you make of that call, and what do you make of that issue?
Well, certainly there's a lot of interest around, shareholder protection, broadly speaking, with consumers. And certainly when you see stocks as volatile as Tesla, there's a lot of consideration around how those management teams and boards, look after shareholders. You've also seen, a lot of money made both on the long and short side with the stock. And there's been, like you said, a lot of noise around Elon's behavior and how the stock gets managed. How the company gets managed. And so I think at this point, having not looked at any of those documents or those filings, I can't really comment on the specifics, but I think there's going to be an ongoing, consideration for the SEC, for consumer advocates, and with Tesla, especially as its influence grows increasingly going forward. Now, that said, what we've seen historically is that Tesla has been very aggressive around defending its position, and Elon's been very aggressive about defending his position. And so I don't think they'll back down on any of these issues.
Colin, there's a lot of talk about range anxiety with regard to people who have EVs or considering getting an EV. Is the charging network enough for deeper penetration when it comes or just more market growth when it comes to Tesla and the amount of chargers there are?
I think it's a great question, and certainly there's the use patterns for vehicles writ large, and there's a couple of things to note here. One, the electrical network is widely available across almost the entire country and most developed countries, and so there is potential access for vehicles to be charging at any number of points all along that network. Two, the build out of chargers is still very much in its nascency, and there's two elements of this. One, actually installing those chargers, but then two, managing the chargers and the impact on the grid. And we think the controls are really important here. And the potential supplementing of batteries. We cover a company called ChargePoint, ticker CHPT, which we're actually quite bullish on, given their, leadership from a controls perspective and public charging, particularly in the U.S. And so we think there's still a lot of room to run on this infrastructure build out here through the balance of the decade and into, post 2030. And so at this point, from a range anxiety perspective, I think, folks that actually have vehicles have found ways to manage that. And there's one, a fair amount of infrastructure available now, so you can kind of solve that problem. The real issue is when you're doing long road trips, and so there is, I think, still a fair amount of build out left to happen around those issues. And Tesla certainly is a leader in that regard with its supercharger network, and we're seeing a lot of the OEMs look at what they need to do to enable sales, and signing up for access to that supercharging network has been a capital efficient way for them to pass on some of those costs to their consumers without actually having to spend the cash for that infrastructure themselves.
All right, Colin Rush, thank you so much. Oppenheimer Managing Director and Senior Research Analyst. We appreciate you. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. We've got some great interviews on tap all day here on Yahoo Finance. Jared Blickery will speak with one analyst who says the next few quarters could feature some prominent ventures going public. Stay tuned for that.
Plus, why one analyst says there is more work to come for the crypto industry. Jared's going to talk to JMP Securities' Devin Ryan coming up in the next hour.
And stay tuned for our 3 to 5 p.m. show today. Our very own Jennifer Schonberger will sit down with SEC Chair Gary Gensler as the Security and Exchange Commission goes head-to-head with the crypto industry. You don't want to miss that.
No, you do not. Jared Blickery indeed has you for the next hour of trading. Stick around.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery. Here is what I'm watching today. Earnings season rolling on this week with heavy hitters like Goldman Sachs, Tesla, and Netflix all taking center stage. We're going to break down what investors should be watching. Also, deflation fears escalate, and that's after fresh economic data out of China showed GDP. It grew at a slower pace than anticipated. We're going to discuss how the street is reacting. Plus, why one analyst says there's more work to come for the crypto industry as the battle over regulation continues. We've got that conversation this hour. But first, let's take a look at the markets. And we can see it's been a mixed day so far. And actually, we got everything in the green right now. The S&P 500 finally ticking higher by about 8 points. Dow up about 60 points, as you can see on your screen. And the Nasdaq up nearly 0.5%. And let's also take a look at the Treasury market. We've seen yields depressed lately, and we have kind of a mixed board here. The 5-year, we're going to call that down just barely. 10-year up about 0.4 basis point, and the 30-year, that's up 2 basis points. So not any big movements right there. Now, S&P 500 earnings, they are expected to drop by 7.1% in the second quarter. That's according to FactSet. And that would be the sharpest earnings decline since the second quarter of 2020. We remember what happened back then. Financials and consumer discretionary are expected to lead in the year-over-year growth in revenues, while energy and materials projected to have the most revenue declines. Joining us now is Cole Smead, Smead Capital Management CEO. And Cole, great to see you here again today. Outlook for this quarter looking a little bit muted. What are you expecting here?
Yeah, great to have me on. Thank you for letting me join you. To your point, in the energy space, we can find it probably the most interesting right now because we've seen this big 1 year down move in the oil price, and yet the stock prices are not giving all that up because, frankly, they've paid off their balance sheets in what some would argue is a miraculous way. And yet, at the same time, this might be the most hated bull market in energy stocks in U.S. history. I say that because if you look at how big they are as a percentage of the S&P 500 or investor enthusiasm, I've rarely seen stocks double, triple, quadruple, and no investors are calling their broker begging to buy them.
Well, Cole, I'm going to direct everybody's attention to the Wi-Fi Interactive. Just want to show something quick on our screen here. This is the year-to-date performance in energy. To your point, 2021 was a blockbuster, or 2022 too was also a better year for energy than it was for many of the other sectors. Here's a 2-year look at energy, and we can see Occidental Petroleum. I know that's on your hit list here, but one of the things facing a lot of these oil companies, especially ones that are engaged in the shale oil play in the Permian Basin in Texas, is they've had a really rocky road. Investors, they want shareholder capital returned to them. Meanwhile, the companies don't want to spend too much on CapEx, and it kind of leaves us where we are today. Maybe you could just kind of break down exactly where that is.
Yeah, and don't disagree with you. So a lot of these energy companies, and I was just up at the Calgary Stampede in Canada, where a lot of the Canadian E&Ps get together as well. They're all looking at these investors saying, what should we do? And asking the investors, okay? Now, those investors, to your point, are saying, hey, we want capital return to them, okay? That's primarily via dividends and stock buybacks. Now, the only danger in looking at investors and saying, what do you want? Is those same investors back in the 2010s said, drill, drill, drill. And they foolishly followed those investors. So we don't like the idea that investors should dictate the capital allocation of companies. For example, we hear a lot of Canadian and U.S. oil companies say, oh, we need to pay dividends, as though like the gnomes of Zurich who collect dividends are some magical creature out there that you want to have in your shareholder base. We don't agree with that. We think this comes down to what can you get per share in your own stock versus acquiring other oil companies, because the tightness that we're seeing, and a tightness, while, as you just said a second ago in your intro, that China has not come back in a rapid way.
Sure.
The tightness that's still present in the market with Europe tipping into recession, this argues that these markets are very tight despite negatives coming in the way of the oil price. And the question is, who is going to be the king of oil? Who's going to have the most barrels flowing for a very long time? And we think the aggressors in this market in the energy business, whether it be on the part of investors or the producers themselves that want to get more oil from other issuers, those are the winners of the game.
All right, we were just looking at crude oil, WTI on our screen. It looks like it's about $75 a barrel. Talk to me about the price of oil for a second. OPEC plus, usually a big factor. We've just had Russia pledging to cut more barrels. I don't think that's supposed to have taken effect just yet. But OPEC plus, usually a factor in the price of oil. How does this fit into your investor thesis here?
Yeah, the old saying is don't fight the Fed, and I wouldn't fight the Saudis. They play, effectively, they are the Jay Powell in the OPEC plus model. So that's the first thing I'd say. But secondly, as you think about the overall picture of the supply, you have them out there cutting, and you have American producers who can't produce any more in effect. So I think those two dynamics are very much at play, and demand is increasing, though, as we just talked about, China is not coming back as a demand factor as quickly as thought. So we have supply dwindling slowly, but pretty predictably in the last 2 years, and we have demand creeping up. So we really like that imbalance. It doesn't ever tell you when price is going to change, but you can study supply a lot better in the long run and understand economics. Demand can be a lot more fickle. Those dynamics being at play, I think, is just kind of a godsend But again, most people look and say we're not going to need new supply in the future. They think that we need less energy, that the idea that we're going to go to a far less energy intensive future. And unless we're going to be living in log cabins with no electricity, I think that looks futile. I mean, I was just down in Mammoth, and there's tons of hippies that pull it off all the time. I just don't see most of San Francisco or New York trying to do that as well.
Well, I tell you what, oil is definitely a politicized commodity. We've seen the draining of the SPR, that's a Strategic Petroleum Reserve, that Biden has enacted in order to stabilize oil prices, keeping them from spiking too much. Arguably a political decision. So politics does enter the field quite often. Just tell me how that's playing out as the world tries to march toward a green energy future. Yet, as you just laid out, needs that those dead dinosaurs, because if nothing else, the plastics that we use and many other things use them besides what we consider the typical uses for fossil fuels.
Yeah, you're right. Very politicized. Whether you look at the United States in the case of using the SPR, again, it's a strategic thing. It was used politically. That's the history of the Strategic Petroleum Reserve, is a political tactic. But then you look at places like the UK, where they're continuing to tax production in such a way that it's shutting itself in. The producer's not willing to produce. So I think governmental policies are taking resources and making places in their country unresourceful. If you think of like a California model, there's vast amounts of oil below LA, but we don't produce it, frankly. Now, some could say that's because of real estate values. I wouldn't disagree with that. But the point is not whether we have resources. The point is how we're using our resources. So if you take that and you then pivot and say, okay, let's talk about climate change or decarbonization. The oddity to where we're going is, if we want to have a much larger economy and we're going to use a lot more technology and have a lot greater human flourishing in the future, humans tend to solve the problems they want to solve, which means if we want to solve carbon, we will solve carbon. Now, the knock-on effect, though, is that it means that we're going to have carbon investments for far longer than people think. Solving carbon actually makes the duration of carbon investments much longer because, again, you've solved their ills. And I don't think investors understand that right now. If you want to prove there's not a God, you'll prove it. If you want to prove there is a God, you'll prove it. If we want to go out and solve carbon, I think the profitability of the energy companies are totally misunderstood. And we could wake up seeing them 10 to 12% of the S&P 500 over the next 10 years.
Well, that's really interesting, because I think the last time that happened, I was probably a child in the 80s growing up. Although I do happen to know that Exxon was the largest company of the world in 2012, about that time period, overtaken by Apple. So these things go in cycles. If you could just talk to me a little bit about the concentration that you were just talking about. People have been talking about the stock market that we're facing today, the Nasdaq 100, how heavy it is with tech. How does concentration affect the way you're seeing your portfolio?
So in 1980, energy was 30% of the S&P 500. I think if I remember correctly, it was 8 of the 10 largest market caps globally were energy. Okay, and a good just guide to life and investing in the stock market: avoid the 10 biggest market caps in the world, and it's just a good starting place. So I say that because we went from 30% of the S&P being energy companies in 1980. Today it's sitting at call it, I think it's sitting around 4%. Okay, so that's how far we've come in that. Now, again, go back to 2008. I think the high point in 2008, when oil was $147 a barrel, was 15%. So you've seen slowly but surely over time, it's whittled itself down. But the question is that, using the post-Ukraine world, do we look at oil and gas as a 4% importance to the overall economy of the world? And I would argue vociferously, no. We found out pretty quickly it's not. The question is, when do investors change their enthusiasm? Now, invert what we just talked about on the energy market caps as a percentage of the S&P 500. Again, the 10 largest market caps in the world are a fool's strategy in the long run. So that was Japanese stocks in the late 1980s. That was U.S. tech stocks in the late 1990s. It is American tech dominance today. And so the dangerous part of the concentration of the S&P 500 is it's so housed in the 10 largest market caps. It's a nightmare for the S&P 500, and it's a nightmare for investors concentrated in those 10 largest market caps. That's one of the better things going on for energy. You don't have to wonder if you're in for hell. You're not part of the 10 largest market caps right now.
Really interesting, and I was impressed how you were able to rattle off a number of those statistics just off the top of your head. I want to shift gears a little bit. One field that has been highly correlated with the tech sector this year is actually home builders, and it's not necessarily because they're doing the same thing, but let's take a look at the Wi-Fi Interactive one more time. This is a year-to-date performance of home builders, and we have Hovnanian here at 160% in the upper left, Beazer at about 130%. KB Home 70%, Toll Brothers 65%, goes down from there. But this is another secular theme that I know your firm has centered on, and that is the lack of housing for new entrants in the market. That would be millennials and Gen Z over the decades. So how is this playing out in your portfolio?
Yeah, we talked about supply with energy. Remember I said that you could really focus on supply and understand economics a lot better through supply versus demand is fickle. That has been housing this year. If we sat here 2 or 3 years ago and I said, hey, we're going to have 6 or 7% mortgages, anybody in their right mind would have said housing is going to get killed and home builders are going to get crushed. Now we sit at those rates, and to your point, the home builders are sitting at all-time highs because what they produce is scarce. And that's all you really want as an investor, is to have a business where what you produce is scarce and needed in the open market. That is exactly what's going on with home builders. So even at lower volumes this year, they're producing massive profitability because, to your point, the millennials are coming, is how I think about it. And the millennials are running into very tight supply, which means that people will buy homes based on needs, not based on wants. And when babies are born, babies build houses. And that's the great part to this. Human flourishing causes greater economics and housing. So just like I said, we think humanity is going to flourish and we're going to need a lot more energy. We think humanity is going to reproduce and flourish, and we're going to need a lot more housing, and we're just doing that on very tight supply.
Yeah, and mortgage rates, then, not the headwind that people thought. Really appreciate your insights here, as always. So that was Cole Smead of Smead Capital Management, the CEO. And all your markets action is ahead. Stay tuned. You're watching Yahoo Finance.
What do you believe the tenor that banks need to strike, especially coming off of the crisis and the turmoil that ensued in March of this year?
I think the banks really need to give off a feeling that they have solid balance sheets. They are in good shape. They're willing to serve their consumers. They've got those net interest incomes that are going to be strong, and we've seen that so far already this morning. So I think they want to give off a positive note with a little bit of cautiousness. Obviously, Jamie Dimon and what he's going to say is going to be key for the rest of the group and what the stocks do going forward. But I think they want to give a sense that they're in good shape.
Let's do a quick check of the market sponsored by Tasty Trade. We see all three of the averages in the green. Dow just barely up 15 basis points, S&P 500 up 0.2%, and the Nasdaq up 0.5%, led by, guess what, financials, tech, and industrials. Interesting mix there. Now, deflation fears grow for the world's second biggest economy after disappointing growth data. China's second quarter GDP grew at a slower than expected pace of 6.3% on an annual basis. Data also showed the first economy-wide price declines since 2020. Wall Street is reacting with Citi, JP Morgan, and Morgan Stanley all cutting their GDP forecast to 5%. Joining us now, Yahoo Finance's Ines Ferre. Ines, these numbers are a bit concerning, especially with all the comings and goings, the problems they've had in their property sector as well.
Yeah, that's right. And the bullishness also that you had heard from analysts at the beginning of the year when it comes to China and the reopening in China. So as you had mentioned, that 6.3 on an annual basis GDP growth for China, economists are paying attention more on the quarter to quarter. That's because last year China was in lockdowns. And if you take a look from the first quarter to the second quarter, GDP grew by 0.8%. So that's less than 1%. Also worthy to note that unemployment among the youth in China is sitting above 21%. So as you had mentioned, some firms on Wall Street lowering their target when it comes to GDP for China, with Citi lowering it to 5% from 5.5. You have Morgan Stanley lowering it to 5% from 5.7, and also JP Morgan to a 5% down from 5.5. Now, consumer spending, economists note, that has slowed down, and that was seen as the main driver for the economy, for the recovery. Also, another concern that economists have is that China's stimulus, whatever the government decides to do to just help the economy, won't be enough. And that commentary coming from Citi economists saying that that growth target now is taking into account a more realistic policy when it comes to the coming months. Goldman Sachs also saying that they're expecting to see some more targeted stimulus. And property, as you had mentioned, in the dumps. I mean, property developers that have declared bankruptcy, that have defaulted. This is a big issue. And one of the commentaries that came from a BNP analyst is that the only growth driver left in China is investment, whose biggest problem is property. Now, keep in mind, if you do stimulate too much, we all know what happens with that. You have growing debt, you have inflation concerns going forward, and then, of course, the flow of capital may be interrupted because your assets aren't as attractive.
Yeah, about sums it up, Ines. Not too many bright spots looking over in China, at least on the recent economic data. Thank you for that, Ines Ferre. And big news from Ford this morning, slashing the price of their popular electric F-150 Lightning by almost $10,000. Yahoo Finance's Praz Supermanian joins us with the latest. Praz.
Hey, Jared, how's it going, man? So yeah, big price cuts here for the Ford F-150 Lightning. Like you mentioned, as much as $10,000 for the Pro base model, but price cuts go across the board, anywhere from 9 to 60% off across all the trims. Plus, Ford is offering $1,000 off this month as an added bonus. So what's going on here is Ford says that they're seeing moderating materials costs and they're improving scale at their Rouge plant. That's bringing down kind of the cost there for producing these F-150s. But the price cuts are coming as inventories of new cars rise across the country, including for once hot EVs. Those inventories are rising even more than traditional new cars. So nonetheless, this pricing plus the federal EV tax credits are making the F-150 Lightning a relative deal right now.
And on the Tesla front, we're talking about the Cybertruck. Finally, it is rolling off the assembly line. I guess critics would say 2 years late, but it is. It's right there. It's on my screen. I can see it. What do you have there in terms of details?
Yeah, you know, the news of that over the weekend causing Tesla stock to charge higher here. Earlier today, hitting levels not seen since fall of last year. But yeah, Tesla tweeting out that pic of that first Cybertruck produced at Giga Austin. Now, like you mentioned, 2 years after Tesla said the Cybertruck would come out, but nonetheless, here it is. Now, what we don't know if this is just a pre-verification build, meaning the truck was just the first to go through the production line and won't actually be put on for sale. So we'll see what Tesla and CEO Elon Musk have to say about that. But it sounds like Tesla is on track for holding that customer delivery event later this year in Q3 and beginning limited production of the Cybertruck at Giga Austin.
Praz, we got another minute, so I'll give you the floor here. Anything else in the mobility space that is catching your attention today?
Well, Jared, just kind of on the sort of the bounce off that Tesla news this weekend, we saw that, of course, Ford today announcing those price cuts. I don't know if it's actually the reason why is because of Tesla's announcing this Cybertruck coming out soon, but maybe that could be the reason. But Rivian also just today released a video talking about the new dual motor powertrain for their R1T and R1S SUV, kind of trying to trump the news cycle here, because I think there is concern that once Tesla gets the Cybertruck up and going, there's going to be a tremendous amount of sales there, kind of eating into the Rivians of the world, and also the Ford F-150 Lightning. And also, there's also reports that Tesla will launch the Cybertruck at a 350-mile range trim, not the 500-mile range trim that they've been talking about, at least not right now.
Gotcha. And I was just looking at Rivian stock price down 4% today, so maybe a couple more announcements needed on the horizon. Thank you for that, Praz Subramanian. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
How would you describe the state of the consumer right now?
I don't think you ever want to underestimate the consumer. We've said it all along. They always find a way to spend more money. I heard someone say the consumer spends money when it's happy and it spends even more money when it's sad. So I think if we are going into a pullback later this year, the consumer is going to use some of that pent-up savings they have, even though they've been spending it already, to continue, especially as we head into a holiday season.
Florida Governor Ron DeSantis has been accusing President Biden and the Democrats of fueling inflation and poor fiscal management. Ironically, Florida's high inflation is gaining national coverage as it's well above the rest of the United States. The Miami, Fort Lauderdale, West Palm Beach metro area jumped 9% in the 12-month period that ended in April. In the Tampa, St. Pete, Clearwater area, they saw inflation hit 7.3% year over year in May. Now let's bring in Yahoo Finance's Rick Newman to discuss about how this is impacting, hey, Rick, DeSantis's election hopes. But, you know, Rick, we've talked about this for years, you and I, on these shows about how the president of the United States really isn't that much responsible for the economy, and it's not for a lot of the indicators. Trump, well, maybe he changed that a little bit because he loved to have the stock market as a referendum on his personal economy. But, you know, in this case, can you really blame a governor for inflation that's in one particular state?
I guess I'd say two things about that, Jared. One, you're right. A president and a governor really don't have that much control over the economy, and the Federal Reserve has a lot more to do with inflation than any executive. But voters still hold the person in charge responsible, whether that person deserves it or not. And there's some fresh grumbling coming out of Florida with these inflation numbers. So just to put this in context, the Labor Department surveys, I think it's 21 cities as part of its monthly inflation report. And those two cities in Florida that they report on now have the highest inflation rates of any cities in that survey. And for each of those, Miami and Tampa, it's more than double the national average. The national average is just 3%. So Tampa's got 7.3% inflation, and Miami has 6.9%. The big driver here is housing. Part of this is that Florida is a popular state. Lots of people are moving there. It's the fastest growing state. So demand for housing is not keeping up. That's pushing up prices. But Florida also has this unique problem we've talked about before with homeowners insurance. There has been all kinds of fraud and litigation in the homeowners market, which has pushed a lot of insurance companies out of the state. They've just thrown up their hands and said, we're out of here. We can't deal with this. So a typical homeowners policy in Florida is $6,000 a year. The national average is just $1,700 a year. So that's another big driver, too. DeSantis did push for some reforms to that. He signed some laws last year, but he and others say it's going to take at least a couple of years before that lowers insurance costs. And meanwhile, some of DeSantis's critics in Florida are saying he needs to get back here to Florida and address some of these problems instead of campaigning in Iowa and Texas.
Well, and let me ask you about DeSantis's campaign. It appears there have been some staffing issues. How is this affecting not only his campaign, but also his governorship in his home state of Florida?
He's cutting costs. So the campaign is getting a little bit ahead of itself, it seems. DeSantis is doing a pretty good job raising money from big donors. He's not doing so great with small donors who send in 20 or 30 bucks here and there. He is getting pretty good donations from some in the business community who think they want to see DeSantis displace Donald Trump as head of the Republican Party. But he's spending a lot, too. And he has he's campaigning like a front runner, and he's spending a lot of money. So the campaign recently said they're going to cut some costs. They're going to trim some staff members. It remains to be seen whether this will affect the campaign or not. But, good campaigns need to be pretty lean. Even if you have a lot of money, it pays to run a lean campaign, and that's where DeSantis seems to be pivoting.
Lean campaign. I'm not going to hold my breath here, but always great to talk to you. Thank you for that, Rick Newman.
See you, Jared.
In a shock ruling last week, Judge Annalisa Torres found Ripple Labs had not violated SEC rules by selling its XRP token on public exchanges. The decision throws a lot of U.S. crypto token regulation into disarray as investors try to understand how future cases might be settled. Now, Ripple Labs CEO came out saying that the SEC has, quote, sowed confusion in the market and really been a bully going after weak players who couldn't mount proper defenses. We're joined now by Devin Ryan, Director of Financial Technology Research at JMP Securities, a Citizens company. So let me just ask you, at first blush, this seems like a huge win for Ripple customers, at least people who own the tokens. I dive into the ruling and it looks like the sales on the secondary market are a little bit cloudy. maybe highlight for some of the people in the audience here what the various facets of this ruling mean.
Hey, good morning, Jared. I think the biggest thing that we took away from the ruling is really around XRP, the token. And our understanding from reading the summary judgment was that the token itself is not the security, which I think has very important read-throughs to the rest of the industry. But then the other piece of it is that depending on how the token is sold, that will deem whether it's a security or not. So on one hand, the institutional sales to institutions were deemed as securities transactions, and that piece of the case is going to go to trial. And then the retail transactions and the trading on exchanges, my interpretation is that that is not deemed as securities transactions. So if you think about the implication for firms like Coinbase or others in the industry that run exchanges, I think this is a very good outcome, but this is just one piece of the puzzle. This doesn't end other regulatory actions that are happening concurrent to the Ripple case, and so we'll have to continue to follow from here. But definitely a win, as you mentioned.
Yes. Well, let me ask you about other court cases that are pending right now. There's been a huge crackdown on crypto in general. Gary Gensler, chair of the Securities and Exchange Commission, is on record saying that everything except Bitcoin may be a security that needs to be registered. Well, that's a pretty blanket statement right there. How does this ruling affect or maybe put some shade on those statements by Chair Gensler?
Yeah, well, I think what the industry is looking for is clarity here, and there's been a lack of clarity. And so there's statements made by regulators, but then there's actions that seem to go against some of those statements. So what we just learned, at least in one court, is that the view is that certain digital tokens, including XRP, are not inherently securities. And so that gives at least clarity for now around that one topic. But I think that will continue to be challenged. Where I think the industry here is going is really that to the point of we need there to be legislation. There needs to be action out of D.C. and there is some progress on that front. And I think that this ruling could help accelerate that. And so that would that's one point that I think is positive and something that people are kind of taking out of this ruling, that this may be an accelerant to getting more done in D.C. on the topic and really defining the rules of the road, because that's really what the industry has been lacking. And so therefore, this ruling is a positive, but we still don't have clear rules of the road, and that still needs to come here.
And you mentioned legislative action. That would probably be the clearest, because then you have the intent of the representatives in Congress who represent the American people making the case, instead of trying to reinterpret decades-old securities laws. Is there a chance that we see any kind of incremental regulation on the crypto front, or from Congress, or do we have to wait for the SEC and these other agencies that have been very slow to give guidance to finally give that guidance?
Yeah, I think that's the hope, that Congress is already looking at certain legislation, and there's been some that has been progressing. And so I think the hope here is that we get action on that over the next year or so, and some of that is potentially going to accelerate just on the heels of this ruling, which adds kind of more of a legal framework from the courts around how they're thinking about it. Again, it's one court, one ruling, but I think kind of it pushes the industry forward in that direction. And that's also, if you take a step back and you look at how a lot of these stocks or related stocks have reacted and been reacting, it's been very favorable, because it's essentially adding, I think, the probability more in their favor. And so that's been something that just even over the past week, you've seen some pretty significant moves. And so, there's still a lot of work to be done for the industry. There's still a lack of clarity. This one ruling in and of itself does not create precedent, but you need to start somewhere. And I think this is definitely something that's positive, and the industry is going to use this momentum to try to get, I think, more action in DC, which is really, again, what's going to create the real definition and the rules of the road for the industry.
Well, let me ask you then, we have just under a minute to go. Anything we haven't covered here, anything that you'd like to highlight that you think could drive either tailwinds or headwinds for these crypto tokens, stocks, anything in there?
Yeah, I think one of the biggest things is institutional adoption. I know that's something that people have been talking about for years, but we really haven't seen it in kind of a traditional way. And the reason being is because institutions acting as fiduciaries for their customers really need to have clarity around regulation. And so, this is a positive step, but this does not bring full clarity. And so, I would say that we've been in an environment where, capital has been constrained, and because of the uncertainty, institutions have not been in the space. To the extent we get more, positive developments, just like we saw last week, that could really be the catalyst to drive what I would say real capital into this industry. And that's going to do a couple things. It's going to accelerate innovation in the industry, and it's also going to accelerate adoption, I think, both on the institutional side, but it'll also drive more retail folks into the space and understanding what the different types of innovations are in blockchain. So to me, that's really what we're looking for, a little bit more clarity. This is a positive step, but a progression here so that institutions can really come in and bring capital with them into the space. And I think that's really what's lacking, but I do think that that's coming here because the space is not going away. There's so much money that's already in the space. It's not going away. So we just need to get better rules of the road. And I think that's what's coming next.
I agree there. After 2 years of a crypto winter, obviously attention on the space is a little bit down, but you have to think that if it's still around and given the billions of dollars of prior investment, that it's here to stay here, at least for a little while. Appreciate your insights, Devin Ryan, Director of Financial Technology Research at JMP Securities, a Citizens company. If you're thinking about traveling this summer, you may be closely watching for deals. Ticket prices have spiked and airlines are struggling to provide seats for quickly disgruntled passengers. I know the drill. According to the TSA, the level of people now traveling has surpassed that of pre-COVID, with over 2.7 million people flying as of this past Sunday. The number of canceled flights is skyrocketing, though. Sunday saw 6% of flights canceled, according to FlightWare. Airlines are citing waves of staff retirement and shortages in air traffic controllers as just some of the reasons that they're struggling to keep up with the increased demand. So it comes as a surprise to you, perhaps, that airfare prices took a dive over the last month. News to me as well, dropping close to 19% year over year. With inflation slowing, by the way, airlines are able to take on more of the cost. However, according to data from Axios, airline tickets are roughly half of what they used to cost 10 years ago, when looking at the average American's work hours to afford that plane ticket. Now, all your markets action is just ahead. Stay tuned. You are watching Yahoo Finance.
How would you describe this earnings season? What is your anticipation that one of the big themes or one of the bellwethers will be?
Yeah, well, I think everyone has talked about cost cutting last quarter. I think we're going to be looking at margins this quarter. You've got inflation coming down. You want to know how that's going to put pressure on some of these businesses and their pricing power. I think it's going to be a key component for us to listen to on the calls and in the guidance as to what margins are going to do. It should give us a good clue for next quarter and the second half of this year.
recent initial public offerings have caused a surge of excitement on Wall Street. The previously stagnant market for listing has been reinvigorated by the likes of Value Village, Cava, and Kodiak Gas Services. And more names are rumored to join them, like Instacart and VinFast, as well as Stripe. Companies had been reticent to come to market, thanks in part to aggressive central bank policy, economic uncertainty, and of course, geopolitical risk weighing on sentiment. Russia's invasion of Ukraine and pressures both internally and globally resulted in the IPO market settling down into an 18-month hibernation. You can see it there on your screen, and that's according to data from Wall Street Horizon. So, is it all about to change just now? Let's bring in Wall Street Horizon VP of Research, Christine Short, to help break it all down. Christine, great to see you here. Just give us a skinny on the IPO market. Is it finally back?
I don't know that I'd go as far to say that. I would say the drought is over. You pointed to some IPOs that happened in the second quarter that got people really excited, including Cava Group, Savers, Value Village, Kenvue. So the drought is over, but I wouldn't say the floodgates are ready to open up. Certainly not this summer. It tends to be pretty quiet in August. Will we see a return in the last 4 months of the year? Sure, you're starting to see some things percolate. Like you said, the environment has a lot to do with it. What are going to happen with interest rates, central banking policy? There's still indication that there's another raise or two towards the end of the year. We know that's highly correlated with whether or not people will go public or companies will go public. Also, economic uncertainty. And I think the jury's still out there. We're getting some clues this earnings season to see how CEOs feel. But I don't think anyone is saying right now that there's not a recession on the horizon, that everything's kind of in the clear. But again, we kind of took our cues from the M&A market, and we've seen that pick up a bit. And so that's a great bellwether for the IPO market. But certainly, again, I wouldn't say there's going to be a boom towards the end of the year, but there is some excitement coming up. And you mentioned a bunch of the names that have been rumored.
Yes.
I'd throw Chime in there, Stripe. So there's Birkenstock. So there's things happening for sure.
There are things happening. I was down at the New York Stock Exchange on the Cava IPO date. Haven't seen that many people in a long time, so it's nice to see that activity. But some of these names that we're talking about that have not IPO'd just yet, Stripe is one that comes to mind. I was talking about that in 2019, 2020, 2021. If they didn't go back then, why should they go now? And I know that kind of depends on each company's particular situation, but is the environment finally conducive enough, a little bit less scary than it was maybe a few months ago, for some of these bigger names to finally come to market?
Right, and throw Instacart in there right?
Yes.
As well. We've been expecting them to IPO since 2022, and so these rumors are ongoing, and we're not quite sure if they're going to come to fruition. I do think, look, it's been dry for the last 18 months. I think we're in a place where we're getting more clarity in the IPO market. Perhaps it's a better time to debut now than it was maybe 6 months ago or even a year ago. Would I say it's a prime opportunity? I'm not sure. I'd like to see what's ahead in 2024. So I think a lot of these companies might not make it this year, might want to see what's on the horizon, see what happens next year. But again, more excitement this week. You've got Oddity Tech debuting on the Nasdaq on Wednesday. They just raised their price range, $32 to $34 a share. I think it was previously $27 to $30. So again, there's things that people are getting excited about. Chime and Stripe, those are such huge ones, like Stripe, 55 billion, Chime, 10, 20 billion. These are huge public offerings. So again, are they going to wait till the environment is a little more ideal? I think that's possible.
And when we talk about new listings, SPACs is something that we have to discuss too. That falls into that bucket. If we can take the Wi-Fi Interactive right now, I have this chart that shows of about 2,000 or 1,200 different listings for SPACs. 562 are still seeking a target, and that's based off of some comprehensive data I got from Bloomberg and Yahoo Finance. Of those that have completed deals, only 324, and so a lot of investors probably going to be looking to get their money back because the 2-year time limit that a lot of these SPACs were tied to spend the money is just, it's evaporating right now. So where do you see the SPAC market from where you're sitting?
Yeah, we track the SPAC data very closely, obviously in 2020 and 2021, and they were outweighing traditional IPOs. And so we saw numbers of SPACs just soaring. And then, of course, as you know, over the last, 18 months, we've seen that completely reverse. You almost don't hear about SPACs as much anymore. The data has gone so far down. And so traditional IPOs, when we hear about announcements, not that there's been so many, but certainly they outweigh SPACs, and I don't foresee that flip-flopping again anytime soon.
And what about some of the mix of issues here? I've seen some oil and gas deals. That's not something that we were seeing heavily promoted in 2021. A lot of those were just growth, high growth companies that didn't have a lot of revenue. But we're seeing, I would say, the companies that have come out over last year tend to be stronger than most, and so probably have better balance sheets. I'm just wondering what trends you've noticed when you take a look at some of the IPOs that are finally coming to market here.
Yeah, I mean, just to talk about the three we discussed earlier, I'm seeing a lot in the consumer space, and I think it says a lot about what the consumer is thinking right now, the health of the consumer. So just to take Kenvue, Kava, Savers Value Village. I mean, look, Kenvue, when they came out in May, the stock popped 20% after IPO. It's now down 7% versus Kava and Savers Value Village. Kava, again, fast casual, their stock's up about 7% since they IPO'd last month. Savers Value Village up about 3% since they IPO'd maybe 3 weeks ago. And I kind of looked at these three together and I thought, okay, Kenvue's consumer staples, they divested from Johnson & Johnson. It's brands like Listerine, Band-Aid, all the brand name wellness and beauty products that you come to know as associated with Johnson & Johnson, but that stock has dropped. And I think it's because you're seeing the consumer trade down to store brands, to those often more value brands versus Kava. We've seen, again, you talked about airlines, and I put this kind of in the same leisure group, but fast casual restaurants have been doing incredibly well. So we've seen that stock, perform based off of that. And then Savers Value Village. This is, a relatively new category. Secondhand retail is really picking up. I think people are coming around to that as an option, and especially as they're trading down with accessories and apparel. And we're seeing bargain discount stores like Burlington Coat Factory, TJ Maxx benefit from this as well. So I think it's interesting to see what consumer IPOs have done well in this environment and which have maybe backed off a little bit.
Yeah, and just looking out on the horizon, anything else catching your interest with respect to the IPO market you'd like to highlight right now?
I think right now we're all focused on earnings season, and I think that's going to give us a good idea of what the environment is like and whether or not the market jitters have kind of calmed down, what's on the horizon for the economy. It depends a lot on what these CEOs say, and I think a lot of potential public offerings, those companies that are thinking about going public either this year or next year, are going to be listening to those calls to kind of decipher whether or not now is a good time or not. So we'll be listening to those calls. Started off pretty well last week. The banks seem to be resilient, but I would say a lot of the commentary from CEO was still, focused on uncertainty. Of course, this week we get investment banks, so we'll see what they have to say about the current environment. And then the regional banks. Is the banking contagion that we saw in March, is that over? So I think a lot of potential companies looking to go public will be listening to what those banks have to say.
Yes, and we're going to be listening to those earnings transcripts and calls right here at Yahoo Finance as well. Thank you for that, Christine Short, Wall Street Horizon VP of Research. All your markets action is ahead. Stay tuned. You're watching Yahoo Finance. Tom Cruise's latest mission is topping the box office this week with the 7th installment of Mission Impossible, raking in $80 million in the U.S. in its first 5 days in the theaters. Yahoo Finance's Alexandra Canal joins us with the details. Allie, your mission, I'm not going to say it. Please just tell us.
Accept it.
Would you please just tell us, should I be watching this film?
I love the Mission Impossible movies. I did not get out to opening weekend to see this one, but perhaps that speaks to the larger story of the consumer and how that's shifting, right? Depending on how you look at the current theatrical landscape. But you have to take the good with the bad for this movie because 80 million debut, not too shabby, right? It's a new franchise record. However, it did come in below expectations of 90 million, and that's what's sending shares of Paramount down today on the heels of that news. Paramount, of course, is one of those companies that's been through some significant challenges. It's long been rumored as a potential M&A target, with a lot of analysts calling for them to shut down their direct-to-consumer business, potentially spin off studios. But management has maintained that they want to stay the course, and they're going to be relying on their strong IP and franchises like Mission Impossible to get them to that next level. So the fact that we did see a disappointment, it's not great news, right? Especially since we're heading into a very busy summer slate. We have Barbie coming up this weekend.
Yes, we do.
Oppenheimer. And so far, the expectations are super high. I mean, Barbie's expected to pull in anywhere from 80 million to 100 million in that debut. AMC last week said they already saw 20,000 purchases for a doubleheader of Oppenheimer with Barbie. So right now, I think all signs point to upside.
Okay.
Surprise, perhaps?
Well, let me ask you, it's been a really hot summer. Has the summer been disappointing so far, or has that exceeded expectations?
It depends on what films you look at, right? Disney's A Little Mermaid disappointed, especially overseas, came in roughly on par with estimates, a little bit below estimates. So that's a disappointment. But I will say, compared to where we were last year, even the year before, we are seeing a lot of really strong movies and different type of movies too, right? Not just the superhero Marvel films that we're used to. We're seeing a lot of female-led films, a lot of family-friendly titles, animation, which has largely lagged. Still, we haven't seen a lot of animated movies in the past. So I think the fact that we're seeing a lot of different types of movies in the pipeline is encouraging. We'll see if that can continue through the end of the year.
Nice to see some things besides the Avenger movies, although I do like them as well. Yahoo Finance's Allie Canal, thank you for joining us here.
Thanks.
All right, that is all for us right now. I'm Jared Blickery.